can talk about all this great economic data, but at the end of the day, the market is narrow.
What we are really looking for is a rally to widen out.
There's other values within the market other than technology.
We just expect some of the other parts of the market that have lagged to start to take the lead.
I would like market breadth to improve, not just concentration in NVIDIA, everything that nobody has paid any attention to for a long time.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
What was that comment at the end? Don't talk about NVIDIA.
Yeah, broaden out beyond that.
Okay, yeah. Let's talk about NVIDIA. Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance. NVIDIA up by 14%. We said yesterday a few times, 4% of the S&P 500, 5% of the NASDAQ 100, 99% of the enthusiasm to buy this equity market worldwide. Lisa, just going through the numbers. The numbers are absolutely ridiculous. Fiscal fourth quarter revenue more than tripled to $22.1 billion. As recently as 2021, NVIDIA didn't generate that much revenue in an entire year. As for the profit, at 486% year over year in earnings per share.
Largely driven by their data center division that is up 409% from the same period a year earlier. How do you even comprehend these numbers? We're talking astronomical growth unseen since the time of the railroad or the advent of the internet or even beyond that. And frankly, what we heard is this is just the tipping point. So how do you price that kind of growth, given that we don't know how far it can go?
We'll ask Dan Ives of Wedbush in just a moment. Here's the response from the South Side so far. Morgan Stanley, remarkable strength of AI. D.A. Davidson, unprecedented growth. HSBC, difficult to please. Lisa, it lacks shock and awe, apparently, for HSBC.
Well, to be completely honest, when it first came out, it didn't meet the highest expectation on the street. And so because of that, the shares kind of didn't skyrocket right away. And then people looked at it and said, hold on, guys, this is ridiculously amazing. Can we just reassess here? So, maybe HSBC has one compatriot on the street. What I'm looking at is that you're seeing a read through to other chip manufacturers, to AMD, to other types of players. How far can this go, given that people see this benefit going across industries for the foreseeable future?
The stock is up by almost 14%. If it wasn't for China, Annmarie, this could have been even better.
You have to think if they were able to get the entire growth in their market out of China, how much higher would profit be? They talked about now in the Data 7 Revenue Center, where they're able to get all this money in profit. It's now single digits when it comes to China. And the CEO had this to say on the call. Remember, the U.S. government wants to limit the latest capabilities in NVIDIA's accelerated computing and AI to the Chinese market. And the U.S. government would like us to be successful in China as much as possible. So basically what he's saying is, we're not going to give you the best we can, but these downgraded versions, we're still going to be able to ship to China. And the issue then becomes, is when are these customers in China going to say, we don't want the downgraded chip. We want the highest processor and computing chip you have available.
Speaking of China, it's easy to sit here and get carried away with this being the only game in town. Take a look at Chinese equities, up for an 8th consecutive session. European stocks, if they close right now, all-time highs. Over in Japan, the Nikkei 225 Bramo reclaiming the 1989 peak. Now, we've been talking about this for the last couple of days. GDP is negative in the UK. It is negative in Germany. It is negative in Japan. And we're talking about all-time highs in Europe.
How long can we continue if the U.S. is really the only game in town and artificial intelligence is driving it? If NVIDIA is driving all of the gains, can we really get bullish about Chinese equities and about Japanese equities and about European equities? There's a question also. We got the data, the PMIs out of Europe overnight. And basically, we're talking about service sector expansion for the first time in about 6 months.
Just
Germany. Holy cow. How can you be talking about some sort of expansion, talk about recessionary kinds of conditions? You put this together, you're right. How long are we talking about something that's really driven by the U.S. and just filtering out to other sectors?
Did you see the note from Marco yesterday? Marco Klanovic over at JP Morgan. I'll keep this quote short. We find current market developments odd. Is he alone?
Unfortunately, very much so. I mean, there are a lot of people who would agree with that sentiment, but I have to point to what Julian Emmanuel said, which is FOMO is going to FOMO, and FOMO is going to keep on running until FOMO can't run anymore, and then it will run out. But we're still in FOMO. It's very much on the front burner.
FOMO is still FOMO Inc. this morning. Does that work? We're going to stop that. Okay,
great.
let's just stop that right there. Equity futures on the S&P 500 with a real lift off the back of this story. Positive by 1.2% in the bond market. Yields down by a basis point or two. 430.10. The euro, there's that strength, Lisa, off the back of that data. 108.52.
It was surprisingly good services sector data. It was surprisingly bad manufacturing sector data. But maybe everyone just sort of has shrugged this off because Germany is the sick dog of Europe, or whatever people like to call it. So if that's the case, the fact that service sector spending can keep going, giving it a boom, that currency cross.
It's been boring for you, eh?
Mind-numbing. You can come up with whatever narrative you want and play it in through the cross, and you'll have your story.
The bars are low for Europe, let's put it that way. Coming up this hour, lots to discuss. Dan Ives of Wedbush as Nvidia sparks a global stock rally. Tobin Marcus of Wolf Research as Capital One's bid to buy Discover faces mounting opposition. And Sarah Hewitt of Standard Chartered as the Fed weighs the risk of cutting rates too soon. We begin with our top story. Nvidia surging on the demand to power artificial intelligence. Fourth quarter revenue growing by 265%. In the current quarter, the chipmaker expecting revenue to grow to $24 billion, surpassing Wall Street expectations once again. Dan Ives of Wedbush saying, quote, "This is a game-changing moment for the tech bulls," and puts jet fuel in the tech bull market thesis as the derivatives of AI play out over the coming 12 to 18 months. Dan Ives joins us now for more. Dan, I don't know where to begin. Promise me this. When you're finally wrong on this name, you have to turn up in a black suit with a black tie. But today you get 100%. To wear whatever you want. You're dead on. Is this the only game in town right now, Dan?
Look, the godfather of AI in Jensen Nvidia. I mean, this is really the earnings heard around the world. The most important earnings in many years. And it shows this AI party, it's just getting started in terms of relative to what we're seeing in terms of peak demand. And now, I mean, Lisa talked about it, this tidal wave of spend, it's coming to the rest of tech. And in our opinion, that's going to continue to fuel this tech bull market in what I almost view as a Taylor Swift moment for the tech bulls.
We can get into the broader tech universe, but let's talk about the lack of competition. How relevant is the competition, Dan?
It's silent. I mean, for the next maybe 2-3 years, you'll have AMD, where Lisa Su's doing some others. But right now, they're the only game in town. And that's why when you look at the godfather of AI, Jensen Nvidia, it's the best read for what we're seeing on the AI revolution. It all starts with GPUs, but then it goes to the rest of the software. This is a read for the hyperscalers, for Microsoft, for Google, for Amazon, obviously chip players. But now it's coming to the rest of software. And that's why this is such an important moment for the market. And I think you talk about valuation. Look, I get it. I mean, many with their 30 spreadsheets and valuation models, they're in their bear caves right now in hibernation mode, because I think this is a stock that's going to continue, could be 4 digits.
The CEO is talking about how generative AI has reached a tipping point that has, quote, kicked off a whole new investment cycle. Where is the investment coming from? How far can that go in terms of how much money some of these companies have to spend on generative AI?
Yeah, I think that's really the key question. Look, the first piece of that puzzle we saw with the hyperscale players, Microsoft, you saw Alphabet, Amazon, and others. But now we're actually seeing an acceleration. This could last for the next 2 to 3 years in terms of from a pace perspective, from a CapEx perspective. And I think what you're really seeing is a transformation, a change in IT budgets that's all moving toward this. And that's why the ones that win, from software to chips, anyone that plays in the supply chain, the food chain, this is one. Outside of valuation, some black swan event, I mean, these are stocks that, in my opinion, are going to continue to go higher. And I think it fuels this tech bull market, which is why this was so important with all the market watching.
What are they going to do with all their money? I'm looking right now. They generated $18.4 billion of revenue in one quarter, just simply from the data center division, which is up 409% from the same period a year earlier. Where does that money go?
Well, I think now the godfather of AI, Jensen, puts that black leather jacket on, and he's going to start looking at M&A. I mean, you're going to start looking at acquisitions to really accelerate what NVIDIA is doing. Flex the muscles, the obviously buyback and some other things from a capital allocation perspective. But they're going to get stronger here, from Microsoft to NVIDIA to I'd say big tech. And I think right now for big tech, this is a flex the muscles moment because of what we're seeing on generative AI. You look at that data center number, that's the key. There's just nothing in those numbers that make you think that this is hype. This is real. I think it's a 1995 moment. That's what I'd equate this AI revolution to.
I hate to pour some cold water on that, but China is a massive market for semiconductors, and you're looking at single-digit growth, and that's where they expect it to be when it comes to the Chinese market. What's your outlook, given they're going to be held back in this massive, potentially huge growth market?
Yeah, if there's the biggest, I think, risk is China. Now, right now, they're navigating that in terms of that tug of war. They're able to still deliver the chips, but it comes down to, okay, I don't want the B- chips, I want the A+. Eventually, the rubber's going to meet the road. Next year and a half, I mean, with restrictions, this will start to become an issue. But I think for now, they figured out that tightrope and even some growth in the second half of the year. And that's music to the ears. And look, if that happens for this overall tech market, I mean, it's a get out the popcorn moment.
And what do you see in terms of competition in China at the moment?
I mean, look, there's really no competition because they are the only game in town in terms of that premium GPU chip. Obviously, there's ones that will be there 18, 24 months from now. You look what AMD and some others are doing. Everyone's trying to accelerate that. But Jensen continues to sit there. And that's why when you look at NVIDIA, it's the best and only read for foundational GPU and AI demand. We saw the first piece on earnings with the hyperscalers. Now you see this. I think this is one where at least for the next, call it 12, 18 months, this is actually an accelerating story, not one where it kind of peaks out.
Dan, the market cap change is almost unbelievable. And not just for them, for Meta too. Earlier this month, Meta, in a single day, added $196.84 billion to its market cap, a record addition of market cap in a single day, a record in the history of this equity market. Dan, we might beat that today with NVIDIA. Why is this 1995 and not 1999?
Yeah, and I think that's the question, right? And the reason it's 1995, not 1999, it's because of the numbers. In other words, the monetization's just starting. So when you actually now start to look at these numbers, that tidal wave's coming to software. It's coming to the rest of the chip sector. It's coming to the supply chain. So it shows now the growth that we're going to see from big tech, from a lot of the other 493 stocks, over the next 6 to 9 months. And like I've said, this is biggest tech transformation in 30 years. And you can maybe even argue longer in terms of star of the internet. And it's being led by NVIDIA, being led by Redmond, Nadella. And you look at this, and I think this is one where it's really the start of what we view as a 2-year tech bull market.
Unreal. Dan, thank you, sir. Dan Ives of Wedbush. That name in the pre-market is up by a little more than 13%. Lisa, just unbelievable to see this play out.
A 2-year bull market on the heels of what? A 10-year bull market. I mean, it's sort of the compounded gains.
Had a decade and 12 months on that
Exactly.
stock.
Well, I mean, you had a decade and a day. I mean, here's the question is, what does exponential kind of growth look like after exponential growth, given the fact that at some point you have to think that there are going to be other competitors, there are going to be some potential headwinds maybe?
At the moment, for me personally, it's the ultimate employment insurance. Don't you see it the same way? If AI is going to be as terrific as everyone thinks AI is going to be, and we're all going to lose our jobs because of it, you want to be in that name, don't you?
Well, that's true. That's sort of the downside risk. Although I do wonder, at a certain point, what the barrier to entry really is.
True.
Right? I mean, at this point, is it sort of the hot thing now, but could there be a GPQ, later on that is going to somehow revolutionize thing? I realize it's just completely wrong. I'm going to get all sorts of mail. You don't understand anything. You're right.
I mean, I'm joking, but it's amazing to see. The stock is higher by more than 13%. Plenty more coverage on this name throughout this morning. Don't worry about that. Let's get you an update on stories elsewhere today. Here's your Bloomberg brief with Shonali Basak. Hey, Shonali.
Hey, John. Good morning. Now, Japanese stocks are hitting a milestone. The Nikkei 225 index extending its stellar rally to a record high, closing now above a peak last achieved in December of 1989. Technology shares and chip gear producers leading the gains, and global funds are now piling back into a market that fell out of favor for faster-growing markets like China. Japan now on a path to sustainable growth as it escapes deflation. Now, a woman billed as one of the most likely candidates to become the next CFO of Goldman Sachs is reportedly leaving the firm. Beth Hammack has been with the bank for 3 decades, and she moved into her latest role running the financing unit after being passed over for the CFO role in 2021. No woman has ever been appointed to the role of chair, CEO, president, or CFO in the company's history. Goldman and Hammack declined to comment. And Rivian shares are lower in pre-market trading after delivering a mixed earnings report and a disappointing forecast. The EV maker also announcing plans to cut 10% of its workforce, an aggressive cost-cutting measure it's now taken for the 3rd year in a row. Rivian struggling with stagnant demand and economic turbulence, with the CEO citing historically high interest rates as a pain point. The company has aimed to challenge market leader Tesla since it went public in 2021. John, that's your Bloomberg Brief.
Hey, Shanali, thank you. Appreciate it. Just unbelievable, some of the tension, the difficulties taking place in the EV space at the moment. More on that a little bit later. Up next on this programme, NVIDIA sparking a global stock market rally.
What we are really looking for is the rally to widen out as what I would call basically the cyclical overhang starts to lift.
Based on this morning's price action, good luck with that. That's coming up next. This is Bloomberg. Stocks doing nicely here on the S&P 500, positive by 1.3% on the S&P. NVIDIA rallying in the pre-market by something like 13% plus. Yields are lower by a single basis point on a 10-year, 430.49. Under surveillance this morning, NVIDIA sparking a global stock market rally.
Clearly, there's certain themes playing out, but what we're really looking for is the rally to widen out as what I would call basically the cyclical overhang starts to lift.
Here's the latest this morning. Global stocks rallying after NVIDIA's blowout earnings report in Japan. The Nikkei reclaiming its 1989 high. In Europe, the stock 600 reaching a fresh record, topping its previous peak from January 2022. Ben Gutteridge of Invesco remaining positive on equities, seeing a continuation of disinflation, incrementally dovish policy and resilient growth. Ben Gutteridge joins us now for more. Ben, let's get into that. Why this market's going to broaden out away from these big tech names anytime soon.
Well, I mean, it may not, and I'll do my best to sort of contain my enthusiasm and remain measured. I mean, what a fabulous day for markets. I mean, those things you mentioned about sort of disinflation and easier policy and resilient growth, I mean, doesn't really sort of pique the interest at the moment. Life's all about earnings, and I mean, what a sensational set of results from NVIDIA, and there is great momentum there, and I think the equity market's sort of really nicely sort of set up from here.
I have to say, I try to contain my enthusiasm, but oh my God, it was so great, which is sort of how the market feels right now. Julian Emanuel over at Evercore ISI has been talking about, the potential for this just to be a pile in and think later kind of moment, saying that the high valuations historically lead to incredibly low returns, and saying FOMO operates on its own timetable. Stocks can get more expensive and the momentum ends when it ends, which is often without warning. FOMO, for now, stays bid. Do you agree with that characterization, Ben, that this is a moment of FOMO that is going to run out?
Well, I mean, of course it could, but, I know this is only sort of anecdotal, but within my sphere, I'm spending a lot of time speaking to fund managers, and it's not obvious that lots of fund managers are overweight this stock. I mean, clearly the valuation is at a headline level has been a bit nerve-wracking for more disciplined fund managers, but they are missing out, and that is a huge pain trade for many fund managers. So I think the FOMO trade, as perhaps as ill-disciplined as it sounds to base an investment strategy off, I think there's legs to that, and I think there could be, I think that those suffering that pain could well sort of join this and accentuate this rally.
Which raises this question, and John really alluded to it. When do you see the broadening out? And you were saying it doesn't necessarily have to happen. You could just keep banking on NVIDIA and do just fine. How much do you just have to bank on the headline S&P market-weighted index and forget about all the people who are saying we're entering some new cycle that's going to be some virtuous beneficiary to all the other stocks?
Well, I mean, you have to maintain, of course, discipline in your investment strategy. As sort of difficult as it is, if you're participating, you know, it's just so easy, isn't it, to sort of sit and let this run. I mean, to a degree, it depends where you're coming from, and don't wish to be sort of to blow trumpets too much. But we have talked about in the past our enthusiasm for US stocks, and so our starting position is one where we can actually take some of these profits and maneuver them elsewhere, be it into sort of small caps, into UK equities, international equities, even a bit in emerging markets. But, you know, the scale of profit taking should not displace US equities and US growth equities as being sort of the mainstay in portfolios.
And then you can't just drop the UK in there and expect us not to notice. Let's talk about that. How are you warming up to the UK? What's behind that? GDP's negative. Is that a growth call about the global growth story, or is that an inflation call? The inflation risk that might be just around the corner.
Well, how kind of you to give the UK some airtime on this day of NVIDIA. Yeah, I think there are some very downbeat expectations about the UK economy. We were in technical recession at the tail of last year. That could be the lows. I think the economy's proved more resilient to this higher interest rate regime than anticipated. Could be some fiscal support coming through. And, of course, valuations maybe get us a bit of an eye roll, because I know valuation's been as a long talked about and unrealised tailwind for UK equities. But there is an extreme there, and that extreme has got even greater today. So I think, you know, and there's a geopolitical hedge in there, you know, oil price type shocks, you know, UK will, you know, the UK stock market should benefit from that. So some diversification elements in there as well.
Yeah, that valuation gap has been a valuation trap for quite a while, based on how this market stateside's played out. I want to throw in Japan as well and really talk about the global market backdrop. To see Japan and the Nikkei 225 reclaim that milestone all the way back in 1989 is pretty phenomenal. We caught up with Binky Chowdhury of Deutsche Bank yesterday, who basically just said, look to the FX market. Dollar yen's around 150. And I think what he's alluding to here, Ben, is ultimately, can you get to 160, maybe 170? That's a push. Can we drop all the way back in the other direction? That's the ultimate risk. And for him, Ben, he wants to avoid Japanese equities. What do you say back to that?
Well, yeah, I mean, I think I'm a little bit cautious on Japanese equities as it relates to the sort of proximity to sort of the China growth story. Not totally convinced about the sort of speed of sort of corporate governance change. But, you know, Japanese equities, if you're buying into them, I think given we have all this enthusiasm over here for equities and US equities in particular, and portfolios are sort of leaning into that sort of risk-on position, you know, what's a good hedge against that? Well, probably the yen. And so whilst on a standalone position, you know, the yen might sort of get cheaper, but for portfolio construction, for diversification, it's probably better off being a bit long the yen. So I would say sort of Japanese equities sort of give you some of that, perhaps more appeal than sort of JGBs, and give you that yen exposure.
Ben, are you bearish on anything?
Well, I think cash could be an unproductive asset for you this year. But look, that's a good point. I mean, the 60-40 that got so trashed in 2022, if you have disinflation and resilient growth, you know, that's a nice backdrop for bonds and equity. So it's hard to get sort of too, you know, I'm not a sort of perma bull, but, you know, I think we're sort of set up for equities and bonds here, but particularly equities.
Saying you're bearish cash is just another way of saying you're bullish, Ben. Go away. Ben, it's great to catch up. Ben Gutteridge there of Invesco. That was such a non-answer. That was such a non-answer.
I mean, theoretically, cash could be not a great thing, but it's just that there are better places to put it. But, you know, it's not terrible either. Everything's good. Honestly, the idea that people are coming out and they're trying to contain their enthusiasm, they're wearing multi-patterned shades of lavender and pink, give you a sense of where we are in this cycle right now.
The stock market's not the economy. I get that. But to see Europe at all-time highs off the back of the weakness we've seen there, to see China on an 8-day winning streak, I kind of get that because they've effectively banned net selling at certain parts of the market day. But Japan's struggling with growth. And here we are with equities back to where we were in 89.
What Binky said yesterday was fascinating,
Agreed.
Which is a lot of the companies are deeply tied to the United States, and that's what's benefiting a lot of these companies. Binky, however, thinks they're also leveraged to some other areas which could be problematic, given that there supposedly is a slowing down. We just aren't seeing it in any of the stock valuations.
Can I make a public service announcement, just a brief one? If you're about to leave the house and you're connected to the Wi-Fi, just check you've got service on your cell phone stateside, because many people who left the house this morning thought they had it, then found out very quickly that they didn't. I think there's some problems out there.
Is this personal?
No, I think it's personal to AT&T specifically.
Let's check out the shares.
So look out for that throughout this morning, and let's see if they can get their act together. Coming up, Senator Hawley agreeing with Senator Warren. Opposition to Capital One's pursuit of Discover continues to build. That conversation up next. This is what the stock market looks like when the third biggest weighting on the S&P 500 is up something like 13%. Equity futures are positive by 1.35% on the S&P. The Nasdaq 100 is up by 2 percentage points. Yesterday, just squeezed out a day of gains and snapped a two-day losing streak on the S&P 500. This morning, we're doing far better than just squeezing out a day of gains. If you get to the bond market, 2-year, 10-year, 30-year, haven't mentioned the Federal Reserve at all in the first 30 minutes of this programme. The 2-year is at 466.87, which is something like 40 basis points higher than where we closed the day the Fed last met. Andrew Hollenhorst of Citi said those minutes were stale. Based on the data we've seen between that meeting and those minutes, Lisa, I think a lot of people would agree with him.
Yes, there were some hawkish signals, smoke signals under the hood that people kind of hooked into, that they really emphasized a risk of cutting too soon rather than too late. So people were saying maybe this is hawkish, then yields went to the highest since November.
Do you want to talk about FX? Your favourite cross. This is Bramo's favourite currency pair. It's the euro against the dollar. And really what it speaks to right now, FX, as you all know at home, is a relative game. And what we're seeing in America is relative economic strength compared to weakness in Europe, weakness in Japan, weakness in China. The euro is at 108.50 this morning and positive by 1/3% because we've got a very low bar for expectations. And relatively speaking, again, Bramo, we skipped that low bar.
Okay, this is the reason why I really find this frustrating. We can come up with these narratives that make a whole lot of sense. The bottom line is U.S. is growing much more quickly than Europe. There's a question about whether Europe is going to have to cut rates before the U.S. And basically, we've traded in a range between 109 and 107 for the past who knows how many months. So trying to put a narrative to each incremental move is just feeling a little tired to me.
Markets go up and down, Lisa. It's frustrating, I know. 108.51 on the euro right now. Under surveillance this morning, Nvidia beats massive expectations. The stock surging in pre-market trading and sparking a global stock rally from Japan to Europe. The chip maker surpassing estimates on its fourth quarter revenue and forward guidance. Nvidia CEO Jensen Huang saying, quote, accelerated computing and generative AI have hit a tipping point. Demand is surging worldwide across companies, industries and nations. Dan Ives of Wedbush calling him, what, the godfather of AI?
Yeah.
Just 30 minutes ago.
And what's he going to do with that money? He's going to put on his leather jacket. He's going to go out there
and buy someone.
And he's going to buy someone, which raises the question, who is he going to buy and will he be able to, given the fact that nothing has gotten through, including grocery store deals? So, here's this question of what do they do with that cash and how do they remain the dominant player on the field?
Yeah, Anne-Marie, JetBlue and Spirit, no. Albertsons and Kroger, no. Capital One and Discover, according to some senators, no. But apparently Nvidia's going to go and make a big deal?
I don't think so. Not in this. I don't think not in this market. Given this FTC and DOJ. But one can hope and dream. Also, last night, on top of this, another disclosure report from NVIDIA. It's not just the UK, the US, France, China looking into them. UK regulators also are going to be looking into NVIDIA. They disclosed that last night.
Amazing to see this rally again this morning. The stock up by something like 13%. Dreadful to see this playing out over at Boeing. The head of Boeing's 737 MAX program is out of a job after the mid-air blowout aboard an Alaska Airlines flight earlier this year. Ed Clark is stepping down immediately after nearly 18 years at the company. The move is part of a shake-up in management amid scrutiny over the 737 MAX jets. Executives will also face questions from FAA Chief Mike Whitaker during upcoming meetings in Washington. Whitaker visited Boeing's Seattle area factories earlier this week. Lisa, is this going to be enough to keep some of the wolves at bay around this company at the moment?
No. I mean, right now we haven't gotten answers, really, at the ultimate crux of the issue. We haven't found out what the real problem is and how they're going to remedy it. It makes me a little sad, I have to be honest, after watching planes take off this weekend rather than getting on planes and going anywhere with my son, about the magic of an era that's bygone and kind of what has gone wrong with these planes that have become mainstays of vacation and business. Not to get all poetic.
You're about to talk about how good the food service was 20, 30 years ago. You used to be able to smoke aboard an airplane as well.
Which is scary.
Well, yeah.
Do you know what really scares me? Getting on a plane and seeing the ashtray there and a sign saying don't smoke. That's when you know you're on a really, really old plane.
Actually, I was looking at some of the old uniforms, and they were designed by Versace and things of that nature. I mean, for the flight attendants. So yes, it was a bygone era, but also back in the 1950s, flights were $450 then. So think about transatlantic flights. So think about what they were in real time. So, you know, it's a trade-off, but hopefully not a trade-off with things getting blown out.
The cost is the story, that's for sure. Republican Senator Josh Hawley joining Democratic colleague Elizabeth Warren opposing Capital One's deal to buy Discover for $35 billion. If the deal were to go through, it would create the largest US credit card company by volume. Senator Hawley saying on X, quote, "Sounds like the credit card companies are finding another way to screw the American people. This merger should be blocked and Congress ought to cap credit card rates pronto." Hawley going on to say credit card rates should stop at 18%. Tobin Marcus, head of politics and policy at Wolf Research, joins us now for more. So, Tobin, we'll go through the deals together. JetBlue and Spirit, Washington says no. Albertsons and Kroger, Washington says no. Capital One and Discover, according to these two senators, Washington says no. Is bigger always worse in their eyes?
And from a political perspective, the wings of the two parties that these folks are speaking for, you know, the left wing of the Democratic Party with Warren and Brown, the populist wing of the Republican Party with Hawley, I do think there is a general allergy to any kind of concentration. So it's not surprising to see those folks in particular come out against the deal. It's a relatively narrow swath of voices within both parties, but of course, a politically influential set. You know, Warren's perspective is very well aligned with the DOJ and FTC leadership that's been put in place, and the sort of outside think tanks that come from that quote unquote hipster antitrust movement have also broadly been pretty skeptical of this deal. So, you know, the pressure to scrutinize it, I think, is very intense. Certainly to draw out the review, I see no reason to think this is going to go through quickly. How it goes in courts is a different question, I think. And there, you know, the different impacts on the concentration on the issuance side of things and the kind of pro-competitive impact of strengthening Discover as a competitor to Visa and MasterCard cut opposite ways on this. I tend to think the latter is going to be more compelling when it actually goes to litigation, if it does. But, you know, there are multiple different lenses through which you can look at this deal.
But when you look at this kind of pressure from a leading Democratic voice and as well as now Republican voice, you have to think that this will weigh on this current DOJ and FTC, which you say already aligned with pretty much a lot of messages Elizabeth Warren has already sent out?
Yeah, I mean, the Hawley thing in particular, I think, is not going to make a difference to them one way or another. I have a really hard time believing that Jonathan Kanter is going to wake up and see, you know, Josh Hawley's statement on this and do anything differently one way or another. The Warren thing, too, I think mostly is relevant in terms of shedding light on a pre-existing shared perspective rather than as a sort of exogenous source of pressure on the antitrust enforcers. Like, I don't think that they're taking marching orders in real time from Warren, but do, you know, broadly share her kind of analytical perspective on this. So, you know, it's a useful incremental signal about what they're going to do because they have such shared DNA, you know, more so than because they're kind of directly responsive to the political imperatives that are being laid out by Warren, Brown, Hawley, and others of that kind.
There's a potential government shutdown next week. So I want to get your take on how you see this playing out, given the fact that we do have lawmakers in recess. Do you think there could be a shutdown, given when they come back, they have 2 to 3 days to hammer out appropriation bills to make sure the government is funded?
Yeah. I mean, it's certainly a possibility. I think the likelihood that they actually get a bipartisan deal on an appropriations package in place in advance of the March 1st deadline seems quite low to me. I mean, they're theoretically making progress, but progress is always slower when they're negotiating while Congress is on recess. And by all accounts, there are a lot of sticking points remaining. So the question is more about, are we going to get another short-term continuing resolution? I think the two possibilities are either we get a CR, or I would not be that surprised to see a short-term shutdown of the 4 agencies for which appropriations lapse on March 1st, you know, in this sort of period between the March 1st and March 8th, you know, laddered deadlines. I don't think that there's much willingness to let defense appropriations in particular lapse. But Speaker Johnson, I think, has shown he really does not want to shut down. You know, he promised he was never going to do another short-term CR in advance of the last shutdown deadline. And of course, he ended up doing so. So, you know, push is coming to shove right now on whether or not we get a CR or a lapse in funding. And I think he's made quite clear that his political and substantive judgment is it does not really make any sense to plow into a shutdown that nobody wants. So my operating assumption is that they'll get another CR in place, despite the, you know, sort of moaning and wailing that we get from the right wing on that. But that remains to be seen. Johnson's decision-making has been somewhat hard to predict more than a couple days out.
Tobin, you said that nobody wants a shutdown. Is that true? Does the former president want a shutdown?
Yeah, I mean that's fair, I guess. Neither party's congressional leadership wants to shut down. And, there are some voices. I mean, I don't think that even Trump really sees clear political advantage from this. He and the policy writers at stake are not really the kinds of things, like the things that would be triggers for a shutdown are not really that near and dear to Trump's heart. Like, he weighed in obviously on the immigration and Ukraine deal. That is something that is kind of core to this case he wants to make to voters this year. I don't really think that anything that's at stake in the current appropriations negotiations have that character. So, at some level, he probably has a generic interest in kind of chaos and dysfunction under Biden, but I don't think this is the thing that he's, sort of most mobilizing his persuasion efforts vis-a-vis House Republicans on.
It seems like for the large point of view, we're really moving on from the Alexei Navalny issues and the fact that he was killed or died by unspecified causes in a penal colony in Siberia in Russia. There's a question about whether this was going to actually cause people to have more urgency to pass aid to Ukraine. Have you seen that been borne out in any way ahead of the announced potential sanctions from President Biden tomorrow?
Yeah, I don't think that the Navalny developments really changed the congressional calculations. Even on the sanctions front, what I have heard is that this is largely a sanctions package that has been under development for the second anniversary of the war that's been kind of accelerated and rebranded around the Navalny thing. It's not as if, this is the first conduct from Russia that we have seen fit to punish. I think for the most part, we've already sanctioned everything that we think it makes sense to sanction. So this is not going to be I don't want to say symbolic, but it's not going to be a completely earth-shattering set of sanctions. From a congressional perspective, I continue to think that the way that aid for Ukraine either does or doesn't get done is based on, sort of backroom four corners negotiations between Johnson and the House and Senate Democratic and Republican leadership. I think he's quite genuinely cross-pressured on this. I think his political incentives not to allow a vote on Ukraine aid are quite strong, but he has done the quote-unquote responsible thing in some surprising situations before, with the FISA surveillance extension issue being one case in point. There was sort of an obvious path for him to behave as a movement conservative, to take Jim Jordan's sort of version of that bill and put it on the floor. And that's not what he did. He's sort of gone along with what the Washington security establishment, would have hoped for from him. And so I think it's possible at the end of the day that he just says, you know what, the political cost is going to be real to me from the conservative side, but I'm going to go ahead and allow this to be attached to the funding bills because it's the right thing to do in the face of pressure from the Senate and the White House. But again, I think he's really going kind of day by day and hour by hour. So it's hard to have a terrible degree of confidence about what Johnson's going to do.
Hey, Tobin, we've got to go. It's good to hear from you. Tobin Marcus there of Wolf Research on the latest down in Washington and the fact no one seems to like companies buying other companies. We'll talk about that later. I need to check in on the health of NVIDIA. The stock is up by 14.5%. Lisa, in the pre-market.
Which really means that it's going to be something like $240 billion of market cap added in one day.
Which is a new record, right?
Potentially. This is the question, right? How do you price in astronomical growth that's not ending? I have no idea. Other people are trying to, and evidently it's up.
What multiple do you put on those kind of numbers we went through? It's mind-boggling.
I mean, given the fact that there's, 400+% growth in a year in some of the revenue streams, how do you multiply that?
I checked the analyst recommendations last night to see, is anyone even saying sell this stock, don't hold it or buy it? Last night, one analyst. This morning, that individual has changed his setting to hold, no longer a sell. How do you see results like that and forecasts like that and think, no, actually, you should sell this?
Yeah, I think we call that career risk. When you see moves like this one and you've got to sell on the stock, I think we call that career risk. This stock is up by more than 14%. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Shonali Basak. Hey, Shonali.
Good morning, John. More on NVIDIA. NVIDIA shares up in pre-market trading after the AI darling delivered another eye-popping earnings report. The world's most valuable chip maker says revenue in the current period will come in at a better-than-expected $24 billion. CEO Jensen Huang says demand for NVIDIA's newest products will continue to outstrip supply for the rest of the year. NVIDIA's market cap has increased by more than $400 billion this year, bringing its valuation to $1.7 trillion. Mercedes shares trading higher in Germany, the automaker's gloomy forecast offset by an announcement of a $3.2 billion share buyback program. The CEO warning that its electric vehicles will remain more expensive than their combustion engine siblings for years to come as it braces for cooling demand for cars with a plug. And Apple is rolling out a free iPhone app to deliver real-time scores, stats, and more to sports fans. The app is called Apple Sports, and it's available for download in the United States, the UK, and Canada. It will include stats from the major leagues, including the NBA, MLS, and college basketball. Apple says it plans to add more leagues over time. That's your Bloomberg Brief. John.
Janelle, thank you. I just struggle to believe that's a real story. Like they're finally caught up and they're offering sports scores on a mobile phone.
Isn't that the ESPN app?
I mean,
I just don't get it. Live score, take your pick.
It raises this. I mean, they've been so behind on certain very specific things. Does this mean they're going to sort of tiptoe into it and suddenly do sports bundling and compete with the tie-up?
I've got not much to say about that at all. Just ridiculous. Up next on this programme, the Fed weighing the risk of cutting too soon.
Since that meeting, we in the Fed have gotten the CPI inflation data, which came in very hot, and a gangbusters employment report.
That's next on the programme, live from New York. This is Bloomberg. We are looking for a cool $200 billion market cap move at the open on a single name, NVIDIA. That name is up by 14% in the pre-market, a beat on earnings and a beat on the outlook as well. In the equity market more broadly, up by 1.36% on the S&P 500, the Nasdaq absolutely flying. In the bond market, yields lower by a single basis point, 430.29. Hardly even talking about the Federal Reserve. Under surveillance this morning, the Fed weighing the risk of cutting too soon.
Since that meeting, we in the Fed have gotten the CPI inflation data, which came in very hot, and a gangbusters employment report. So as is often is the case, these are a little bit stale. But my bottom line is maybe a touch more hawkish than perhaps we got out of the chair's press conference in January.
Here's the latest this morning. Minutes from the Fed's January meeting showing members were united in delaying rate cuts. Only a couple of officials pointed to risk to the economy from waiting too long. We'll get another peek into the Fed's thinking today. Jefferson, Waller, Cook, Harker and Kashkari all set to speak. Sarah Huner, Standard Chartered, joins us now for more. Sarah, let's get into the Fed. Does that sound like an FOMC set to cut anytime soon?
It certainly doesn't. I think that we're looking at the earliest at the next quarter. Our own view is June. I think markets are broadly in line with that. Of course, we have to see what happens with the upcoming inflation data, the upcoming employment data. We have a sense that the next core PCE reading is going to be strong after about 3 months of pretty subdued inflation reports on the PCE front. Of course, the all-important February employment report, does it show January just to have been a surge in new hires at the start of the new year? Does it show January to have been a boost in wage earnings growth, again, a new year phenomenon, or is it something which is likely to persist in the coming months?
Sarah, I've been kind of nasty. I've been a little bit mean about the euro-dollar cross and how it's not very interesting because it's the same story that we know on both sides and it isn't changing. And then people basically emphasize different things each day to come up with incremental moves. Am I wrong, or is this basically how it feels to you too?
I think so far it has done, but I think what is interesting about Eurodollar is that we've had a lot of very positive news on the US front. It hasn't done a huge amount to help the dollar recently. We've had some very negative sentiment around the euro area, and yet today's PMIs suggest that it's not all one way for the euro area, so that there are some glints of positivity there. So it does feel as if there's potential for euro to do better over the coming weeks and months as we get perhaps a realignment of expectations, perhaps better expectations, or at least not such bad expectations on the euro area front, and potentially sort of fading enthusiasm on the US front.
Well, do we get the sense that the AI boom is isolated to the United States, or the benefits are trickling elsewhere that people haven't kind of realized yet, and that story has legs beyond NVIDIA?
That story definitely has legs, but it's very much a structural story. And I think it's difficult for markets to incorporate that into the sort of day-to-day. What does it mean for, activity data in Europe? What does it mean for policy in Europe? So it's an important, absolutely fundamentally important aspect of economic activity and economic growth over the coming years. But in terms of this sort of day-to-day market moves, there seems to be more of an influence on the US than elsewhere.
When I look at Germany this morning, manufacturing downturn unexpectedly deepened in February. At the same time, you have Mercedes-Benz, massive German manufacturer, buying back shares. How does the ECB look at all of this ahead of their rate decision?
Manufacturing is important, and clearly it's very important for the German economy. But overall for the euro area, I suspect that ECB is looking more closely at what's happening to services, what's happening to activity in the services sector. What does that mean for employment, which is still at close to full employment, and what does that then? How does that then feed through into wages? We know that they're waiting for further evidence that wage growth is decelerating. We had some indications of that already in the fourth quarter, but ahead of their meeting in April and in June, they'll want to see further clear evidence that there's going to be no upward pressure from wage growth feeding through to inflation and sort of disrupting that steady downtrend that we see in inflation towards the 2% target.
Sarah, with that in mind, could you explain for our audience just how important the upcoming wage negotiations will be in certain countries, including in Germany, going into the middle of this year?
Yeah, super important in terms of what information that gives to policymakers. The wage data that we have here in Europe, in the euro area in particular, is not so timely as we get in the US, and therefore it's very much a matter of what the current wage rounds show, how do individuals feel about the prospects for inflation. There's some slightly sort of worrying uptrends in inflation expectations in the euro area, and policymakers will want to be clear that wage growth is not echoing that, those expectations.
Sarah, the Fed has offered a threshold to reduce interest rates. Basically, Chairman Powell said in the last news conference at the end of January, we just need more good data. Not better data, just more good data, and maybe not even as good. Sarah, what's the ECB said about what the threshold is to reduce interest rates?
Well, it's inflation, and inflation on the medium-term horizon, if we want to be technical about it. So it's clear that for the ECB, the softness in economic activity is not a reason for cutting interest rates. It could be a factor behind future slowdown in the employment story, and that in turn could dampen wage growth. But it's all about inflation and what are the drivers of inflation from the ECB's point of view. And it's these domestic drivers. We're still seeing low goods inflation, disinflation on the food front, but services inflation is still too high. It's 4%, and that's not consistent with getting overall inflation down to 2%.
Hey, Sarah, great to catch up. Sarah Hewen there of Standard Chartered on the difference between the ECB and the Federal Reserve. Some might argue the Federal Reserve has been a little more clearer about the threshold to reduce interest rates. The Federal Reserve, in their minutes, Bramo, I have to say, you can call them stale, you can say they're carefully crafted. I think what it speaks to overall, this Federal Reserve is not in a rush to reduce interest rates anytime soon.
This line in particular caught people's attention. Some officials noted the risk that progress towards price stability could stall, particularly if aggregate demand strengthened or that progress in improving supply chains could falter. This is a new kind of tone, fear of an upside risk to inflation that really wasn't present in the previous press conference.
Biggest risk right now, cutting too soon or waiting too long?
Well, 2 weeks ago, it was waiting too long, and now it's cutting too soon. So that sort of this subtle shift under the hood on the margins has cost a 60 basis point increase in 10-year yields since the end of December.
Isn't it funny? Everyone says one data point doesn't matter, but then one data point really changes the conversation. And that one data point last week was CPI, and then you can make it two with PPI.
Which is the reason why I think people are leaning into this idea that maybe they have more ability to be patient. Now we're just pricing in a 30% chance of a May rate cut. So this is how far people are pushing back. We did see TD Securities actually ratchet back their expectations for rate cuts to only 5 this year from 8.
Just 5.
So yeah, this is clearly shifting people's understanding of what the tail risks are.
Marko Klanovic of JP Morgan mentioned him a few times this morning. The 25% stock market rally since October was predicated on a repricing of the Fed from cutting only twice in 24 to cutting something like 7 times based on January pricing. While most of those incremental cuts are now priced out, the stock market did not correct at all. That remains a mystery for people like Marko.
And then you get NVIDIA, and mystery no more. Because at the end of the day, like Ben Gutteridge said, with not blowing trumpets and not too enthusiastic, basically it's all about the earnings.
NVIDIA right now up by 14% in the pre-market. Coming up next, Luke Cower of UBS Asset Management, Hope Domchowski, CFO of First Horizon, Stefan Bancel, the CEO of Moderna, and Kathy Jones of Charles Schwab. The second hour of Bloomberg Surveillance up next.
Not really sure when the Fed goes the first time. Is it June? Is it July? For most of your viewers, it simply doesn't matter.
The Fed is steady as she goes in many ways, and it's creating, I think, a lot of volatility.
I think inflation is stickier than maybe some folks would have thought.
The lumpiness in inflation is just part and parcel of going through what we're going through, a normalization of interest rates.
A lot of the inflation data that we saw recently was largely seasonal, and that will reverse in the next couple of months.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Never mind the S&P 499. Let's talk about the S&P 1. Live from New York City this morning. Good morning, good morning. Equity futures are positive by more than 1% on the S&P 500. NVIDIA is higher by 14%. Bramo, we talked about it yesterday. Here it is, lighting up this market.
Which would be equal to about $238 billion of market capitalization added in a single day. You noted that that was more than the one-day record gain that we saw in Meta, greater than another Disney added to its market valuation.
3 weeks ago.
3 weeks ago. This is a new era. How do you frame out a seismic shift in technology that seems to be being adapted at a record pace?
We've talked about the reaction from the South Side. Bloomberg Intelligence validates AI demand momentum, vital knowledge, the report, the outlook, quote, great. Wedbush, Dan Ives, game changer, was with us an hour ago. He said it was 1995. Let's sit on that. Why isn't it 1999 when you see moves like the one we saw on Meta at the start of the month and on NVIDIA this morning?
Because their profits, their revenues gained more than 400% year over year. That is different than 1999, where someone put up a shell company, had a .com after the name, and raised $1 billion. So this is sort of the difference right now when you have companies where people can't get enough of their actual products that seem to be delivering something that a lot of people want.
Revenue more than tripled. It's real. It's not fictional. It's amazing. It's just incredible. And what's incredible here, Annmarie, it could have been so much better if we didn't have those problems in China.
This is what Bloomberg Intelligence took out of the report, the fact that revenue was 22.2% a quarter earlier, and it halved in the fourth quarter, 8.8%. In China specifically. So how much bigger could profit and revenue have been if they were able to actually go after the biggest market in semiconductors, and that's China? And obviously they're being held back by export controls, which they said, of course, they're going to make sure they're in line with U.S. law.
I need to do a deep dive on the actual construction of these things. I'm very curious about it because I want to see what the barrier to entry is. And when you have technology that's moving so quickly, it's unclear what the next iteration of this is going to look like. That's the big risk, is that suddenly these things become obsolete. Is it going to take 5 years, 10 years? Is it going to take 2? But we talk about the railroads. We talk about the car and Ford at the time when that was a new product. Is this transformative technology seeing only a 2-year day in the sun, or is it going to be 5 years, or is it going to be 15?
So how important is Fed policy, given what's taking place right now? Do we need to de-emphasize that, given what's taking place with this single name driving these massive gains in this equity market, not just stateside, but arguably worldwide? Let's go back to that quote from Marko Klanovic over at JP Morgan. The 25% stock market rally since October was predicated on a repricing of the Fed. While most of those incremental cuts are now priced out, the stock market did not correct at all. Does this single name explain why Marko is struggling with this market?
I would say yes. And it's not just this name, but AMD, And there are other names as well.
Meta too.
Meta as well. And then if you think, okay, healthcare companies are going to adapt to certain AI, generative AI types of productivity gains, they too can benefit and see maybe outsized type of expansion regardless of Fed policy. This is why it's so tricky. And this is why, frankly, a lot of people's eyes are glazing over when you start talking about Fed policy these days.
NVIDIA right now up 14%. Fed policy, eyes glazing over. Mini Fed meeting taking place today for those of you interested. Tons of Fed speakers. Harker, Jefferson, Cook, Kashkari and Waller, for those of you still interested in what the Fed's got to say, because at the moment there doesn't seem to be much interest at all. Nvidia's up 14%. The broader equity market's up 1.3% on the S&P 500. Bond yields, what are they? Bond yields look like this on a 10-year. We're down almost a basis point, 430.89. Coming up this hour, Luke Carr of UBS on Nvidia's blowout earnings report. Hope Domchowski, First Horizon Bank CFO, on challenges facing the regional banks, and Stefan Bassal, the Moderna CEO, on the company's, quote, year of transition. We begin with our top story. It is Nvidia, flying in pre-market, trading as the AI boom shows no sign of slowing. The chipmaker's outlook blowing past estimates and driving the S&P 500 higher, much higher. The company's CEO saying this: accelerated computing and generative AI have hit the tipping point. Demand is surging worldwide across companies, industries and nations. Luke Carr of UBS joins us now to discuss. Luke, good to catch up. Overweight global equities, congratulations, you've turned to neutral and stocks are still running. What are you thinking now?
Certainly makes you a little nervous whenever you see a blowout report like that from world's most important company. But no, our view has kind of been that a lot of the juice has been squeezed in terms of what we got in the 3 months ahead of going neutral. That was effectively a 97th percentile move in global stocks, the kind of move you'd only ever gotten historically in the past 30 years when we were emerging from a recession or during the heyday of the dot-com bubble. So, the parallels do kind of run there. Obviously, Abramowicz pointed out the differences in fundamentals to that point of view. But from our view, this is not really a bearish call in the economy. It's not really even a bearish call in the stock market. It's really more about squaring up and saying that, hey, after this big run, we just think the risk reward is a lot more neutral in terms of the positioning metrics in particular that we track. Those are the ones that inspired us and kept us in the market, even when we were kind of undergoing some wobbles last year in Q3, late Q4. And those now have turned a lot more, suggesting investors are a lot more engaged. Right now, that just means to us that there's a lot more susceptibility, a lot more vulnerability to any negative shock, whereas the right tail is a function, in our view, of a much more selective part of the market. And we can get exposure to that in other ways or directly.
There is this issue with valuation, and I saw that from Julian Emanuel as well, that typically in the past, when you have this type of valuation gain, you have less than a 1% increase on the S&P at best in the following year. Has history been interrupted by generative AI and a transformative technology that seems to have endless demand?
Well, you never kind of want to fight history too much. But however, that is part of the view. That is part of the thesis, a big part of the thesis for not being underweight at this juncture. It's knowing that, hey, if we still have a positive view on the macro economy, if we still think that, and if anything, we think the left tail for the economy has come in over the past 1, 2, 3 months, not recession risk increasing at all. If we're still going to be a world in which the economy is growing, whether it's 1.5 to 2.5%, do we really think, like you said, Fed policy doesn't really matter to investors much? Does growth of 1.5 versus 2.5% really matter that much in a world where, some of the world's leading companies are growing earnings that fast? I argue, no, it doesn't. So, that is something in which it is a little different this time.
Hold on, just to set the record straight, Fed policy matters quite a bit, just maybe not for NVIDIA. It matters for a lot of the smaller companies that actually have been struggling and haven't seen the kind of growth to catch up with the NVIDIAs of the world. How do you sort of bet on a broadening out without a view on the Fed? Or is the Fed instrumental there in terms of how many rate cuts they do is directly correlated to the strength in some of these smaller companies?
Well, I certainly think that the biggest beneficiaries that we had seen of the Fed pivot were names that effectively needed the cycle to extend, and the Fed was viewed as effectively raising the risk of the cycle not being able to extend because of lagged effects of monetary tightening or what have you. But what happens as growth continues to stay strong, even as the Fed even pushes back the timing of rate cuts, that perhaps opens out a bit of a window for broadening out. However, that is that's a bet we've largely closed in terms of that sense. On the one hand, you do have, I think, some supportive signs from global PMIs starting to pick up, but that's probably more of a measured rebound and has a lot more to do with inventory rebuilding than any kind of genuine thrust to growth that's quite important. And on the other hand, you do have the pushing back of Fed expectations. Do find that quite important, and we do find that earnings growth is becoming more concentrated. We like to follow earnings growth. We know that even at rich valuations, it is going to be earnings growth that is going to drive the market. But the valuation does affect that forward risk-reward proposition, which is kind of how we end up in this more neutral position.
Luke, I was looking at your most recent report. You're looking for faith in a soft landing to be slightly shaken. What do you think is going to shake it up?
I think it will be more slightly shaken than anything, not in terms of the downside risks to the economy, but more kind of what we've seen on the inflation front recently to start the year. So when we're kind of dividing into different economic scenarios and probability weighting, where are yields, stocks, et cetera, going to be in each one, for us, the economy and the rates market has more and more priced a kind of persistent inflation environment. And if you try to decompose the Fed's inflation forecast, how do you get from where we were, the 3.2 Q4 to 2.4 at the end of this year? How do you get there? What does that sequentially look like? In our view, that really looks like almost what we've gotten so far. It involves and it implies 3-month annualized inflation on core PCE picking up closer to 3%. It involves 6-month rising closer to 2.5% in the months to come. So a Fed that's looking for greater confidence, even as I would argue these readings are probably very much in line with their internal forecast on a sequential basis. I think you have to look around and say, well, how is the Fed getting greater confidence if they didn't have the confidence to tee up a cut at 1.9, 6-month annualized core PCE, and now we're running closer to 2.5. So I think that's the kind of environment where it leads to you needing a lot of the narrowness that has supported the market in recent times to continue to be very constructive. That just leads to a narrower risk-reward path that, again, we land ourselves in a more neutral position.
Just quickly before you go, how much weight are you putting on the January data, the early data for 2024?
I would say not too much. The January effect does matter insofar as it's influencing expectations, and we've already seen some of the top bottom-up PCE and inflation forecasters that we track saying, well, there's the risk of this bleeding into February. So I think right now it's kind of just reset the clock on the degree of confidence the Fed needs and somewhat raise the bar that's required. Does it change our view fundamentally on the economy? No, not very much. Does it change our view on the kind of the balance of risks, particularly to risk assets? Yes, a little bit.
Can you just whisper your foreign exchange call, just in case Lisa reaches over the table and punches you?
Certainly, we really do think the dollar is a very good place to be, especially relative to G10, and that's again an assessment of the changing balance of risks. Right now, the kind of no landing, persistent inflation risk has become more and more central. The dollar, in our view, is just the top way to protect against that environment in which stocks and bonds are both selling off. And we do think that in that environment, the dollar is pretty much the only place where you get protection.
I'm not a violent person.
Thank you, Luke. Appreciate that.
I would never be punching
No, of course
anybody.
not. Never. Just in commercial breaks when people aren't watching.
Oh, right.
Luke,
I just
UBS.
do a left hook.
Look, thank you. Equities right now doing okay. She doesn't really, I promise. We're okay. We're okay. Nvidia in the pre-market up by more than 13%. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Shonali Basak. Hey, Shonali.
Hey, John. We're looking at President Biden. He is on a campaign fundraising swing through the West Coast, and he's sharpening his rhetoric against Russia and the Republicans. At an event in San Francisco, he called Vladimir Putin a, quote, crazy SOB, and laid into GOP frontrunner Donald Trump for comparing his legal battles to the death of Russian opposition leader Alexei Navalny. Biden's 3-day California tour has included fundraisers that will add $130 million to his campaign coffers. And the head of Boeing's 737 MAX unit has been ousted from the company. Boeing says Ed Clark is stepping down effective immediately after nearly 18 years of service. The management change is the first since the door panel blowout on an Alaska Airlines flight earlier this year. And Boeing CEO David Calhoun is expected to meet with FAA officials in Washington next week as part of the ongoing investigation. And mobile users in the United States reported increasing trouble connecting early this morning, according to service tracking website Down Detector. AT&T, Verizon, and T-Mobile were among the carriers affected, with Down Detector reporting a spike and complaints at around 3:30 a.m. New York time. And that's your Bloomberg Brief, John.
Janelle, thank you. I was one of those complaints, I'm sure. Up next on this program, bank regulators under pressure.
The regulator has to do their job and understand what's going on in the market. And if there's heightened concern, scrutiny associated with a specific segment, they're definitely coming in and spending more time looking at that.
That conversation is coming up next, live from New York City this morning. Good morning. Stocks on the S&P 500 firmer here, higher, rallying by 1.26% on the S&P 500. Nvidia check. You'll get many of them this morning. Stock is up by 12.5%, off session highs. In the bond market right now, Treasury yield shaping up as follows. The 2-year going nowhere, the 10-year down about a basis point, going somewhere to about 430, 431. Under surveillance this morning, bank regulators under pressure.
The regulator has to do their job and understand what's going on in the market. And if there's heightened concern, scrutiny associated with a specific segment, they're definitely coming in and spending more time looking at that. But I don't think it's anything out of the ordinary versus what would have happened if there was more concern within another sector.
Here's the latest this morning. The KBW Regional Bank Index is down almost 10% this year. Concerns around commercial real estate weighing on lenders and regulators alike, who are looking to avoid a repeat of last year's bank failures. There isn't a lot that First Horizon hasn't seen before. The bank is about to celebrate its 160-year anniversary, and the CFO, Hope Domchowski, joins us now for more. Hope, great to see you.
Good morning, John. Thanks for having me.
Pulled this quote directly from your website. First Horizon has served clients through civil war, 2 world wars, yellow fever epidemics, financial panics, the Great Depression and the Great Recession. Worried about commercial real estate at all?
Yes, always worried. To make it 160 years, you have to think through every economic environment and be prepared to look at whatever's coming at us. And so we look at how do we underwrite through a cycle, and CRE is one of the ones that we do continually look at how will it perform.
Are you selling assets, slowing originations? Have you had to change anything based on the difficulties of other lenders? And I need to be specific about that because your stock has held up pretty well so far year to date.
We have not. We really run a client-first relationship model. And so these are clients of ours. We don't think of them as a loan. We don't think of them as portfolios that we would sell. We are lucky to have top-tier capital. And so we've been able to continue to lend to our existing clients as well as pick up market share from our competitors who have had to scale down their balance sheet or coming out of some of the markets that we're in, as well as shutting down some of their verticals. We're seeing some of our competitors completely get out of some of the products that we love, like mortgage warehouse. And so we've been able to lean in with our top tier capital.
Just to sort of underscore that, have you been expanding those books in response to distress elsewhere?
We've been trying. The pipelines are really come down in the last 2 quarters. So last quarter was our first negative growth on the loan side. 500 basis points of rate increase has really stressed the sector. So as we look at the loans that are coming through, we see less loan demand and less that can really hurdle in this environment. We look at how will it perform through the environment. So even though we're at 500 basis points, we're still looking at we could see another 100 to 200 when we underwrite the loan. We don't think that's likely, but we also didn't underwrite loans 3 years ago expecting it to go up 500 basis points. And so it's a lot harder right now in this environment to originate loans that we think will make it through the cycle.
We talk a lot about where is the growth potential for some smaller banks, particularly in the profitability sector. And I was speaking with you offline and I said, where's growth? And you said, growth is a dirty word. Why is it a dirty word?
Well, for investors right now, growth in banks has been kind of tainted with the Silicon Valley failure, Signature failure, as well as First Republic. Those banks grew really quickly. And so as we're out on the road talking to investors, we're doing conferences, they're nervous about growth in banks too quickly. They see a lot of banks, as John mentioned earlier, selling off portfolios, shutting down some of their product lines, and they want to make sure the banking system is strong and stable. So our investors look at growth in this environment, a 550 basis point Fed fund rate as a little bit risky. And so as we are looking for loan growth, we're still hoping, we still are out there meeting our clients' needs and picking up market share. it is harder, as I mentioned earlier, and the investors know that. So when they see somebody that's picking up a lot of loan growth, they know that there's probably some risk to that. You guys have been talking about it more than I have, but nobody knows where interest rates are going. And so how do you have a lot of loan growth right now not knowing what that interest rate environment to underwrite to?
We talk about it far too much. We've been talking about M&A all week as well. Is this going to be the year of the regulator or the year of M&A?
I wish I knew, John. I don't think there was many banks more surprised to see a big deal go through than First Horizon. We were in May of this past year. We were a deal that was terminated after 14 and a half months of working with the regulators, going through the merger application process. The same week that First Republic failed, we were told that we were not going to get approval for our deal to happen. So we're really excited to see a new deal come through. This is the first big one since the TD First Horizon was terminated. And we're going to sit on the sidelines for this one and run our bank, but excited to see what happens. There's two things we're really looking at in the banking industry with this deal, which is, one, how quickly does it take? We used to see bank mergers go through in about 6 to 9 months. And the two before us that did get approved, they took 12, 13, and 14 months. That's a long time for an organization to be looking at a merger. So we'll be looking at, one, the timeline, but two, how easy is it to get a merger approved in this regulatory environment? And nobody knows right now. And this is a big one. So we're all anxiously watching to see how this one plays out.
Well, what your potential deal with TD has in common with this Capital One Discover deal is some of the calls from Congress saying they should block this. Elizabeth Warren came after that deal. She's also saying the same about this. So where does that leave the idea of M&A in the banking environment? Like, do you think in this environment it actually gets done? Kroger can't get done. Why would Capital One be able to get done?
I hope they can get it done, but we are sitting here, today seeing that the last deal that went through got declined. They are not publicly saying why they would not let TD Bank buy First Horizon Bank, but that there was some concerns they had. So I think the bigger issue for us in banking is scale matters. The cost of technology to run systems today that clients expect and the cost of preventing fraud is just astronomical, and it's increasing quarter after quarter. You heard last year a lot of regional banks increased their fraud costs. And with scale, you have the ability to better handle the client needs and prevent fraud. And I think that's one of the big ones that Discover and Capital One have been talking about, is how do they compete in the market without that scale?
If regulators do sign off on the Capital One deal, are you looking to be an acquirer or are you looking to be acquired? Are there talks going on currently ahead of that potential allowance from regulators?
For us, no. We are happy to be running First Horizon. We're celebrating our 160th anniversary next month. Our company is really excited about our franchise. We're continuing to build our momentum in the marketplace. We're a Southeast regional bank. There's nowhere better to be the Southeast markets right now. We have the top market growth share, and we look at population growth, economic growth, and so we are not in merger talks right now. We don't have any desire to do one in the near term. Longer term, as we start to see M&A open up, we would look at what's opportunistic for us. The bigger thing for us is that $100 billion line for the capital bank capital rules with Basel III. We really have to sit back and say, what is Basel III going to get implemented at, and what will that cost us going from an $83 billion bank to something over 100 with our next acquisition?
So what's the target? What's the sweet spot in terms of size, in terms of the types of businesses that you'd be in?
Well, for banks, I think JP Morgan is the only one that thinks they have enough size. If you're a $100 billion bank, you want to be 200. If you're under a $200 billion bank, you say you want to be 500. And the $500 and $600 billion banks are saying they want to be a billion, right? Or a trillion. So I don't think right now anybody feels they're big enough. I think Jamie Dimon would love to do another merger. Scale just matters, right? It is such, the game of banking is more and more expense coming in and more regulation that's impacting our ability to make money, whether it's the current interchange charges, the cap on, client overdraft fees. So revenue is getting capped as expenses continue to go up. And so scale is one way that we can improve shareholder value by being able to spread those costs across a bigger client base.
Do you think a change at the White House would change the mood music in Washington towards regulation if Trump were to win again?
You know, we've spent a lot of time talking about that with a lot of the, agencies and a lot of the policy groups we work with, and we're just not sure. We're not hearing a lot out of this campaign trail about how they will think about mergers going forward. It was a big one in the last, when Trump won the first time, he said, we're going to make it easier to do mergers, we're going to be open. We're not hearing that rhetoric this time, and so we really don't have a lot of indication just yet as to whether we would see any change with a possible Trump or Haley campaign.
That's absolutely fascinating, and I think that's your big frustration right now,
100%.
There is this feeling, there is still this perception that lingers from the last term that the former president had, Donald Trump, that he would be business friendly and open to massive deals. We've talked about it a million times on this show. Then you see things from, say, Senator Hawley overnight, a Republican. You wonder which way the wind is blowing in the Republican Party.
And if you're wondering, this is what really frustrates me, you're not hearing about it. Instead, you're hearing name calling and all sorts of questions about, adequacy tests and different things of that nature, which just leaves business executives, investors, rank and file Americans in the lurch trying to understand what any of this is going to mean.
What is the policy? We're trying to find out. Hope, it's great to have you with us. You're going to stay with us, I'm pleased to say. Hope Domchowski there of First Horizon. Coming up on this programme, Moderna beating estimates as the company gains vaccine market share. We'll catch up with the CEO, Stefan Bancel. He joins us next. Your equity market's positive by 1.3% on the S&P 500. Nvidia is absolutely flying. It's higher in the pre-market by 13%. From New York, this is Bloomberg. Stocks on the S&P 500, the rally continues. Equity futures on the S&P higher by more than 1%. On the Nasdaq, up by more than 2%. It is all down to this. Under surveillance this morning, Nvidia has done it again. The chip maker delivering yet another sales forecast that blew past estimates thanks to seemingly unstoppable demand for its AI products. Nvidia also saw fourth quarter revenue more than triple to $22.1 billion US. The company's market cap has increased by more than $400 billion this year alone, bringing its valuation to $1.7 trillion. And Lisa, maybe another something like $200 billion of market cap added at the opening bell this morning.
I don't understand these numbers. I mean, yes, they're big and they're getting bigger.
Huge.
And that's okay, great. But I don't understand the trajectory of exponential growth. How long can it continue? What is the multiple that you put on a stock that is growing more than 400% with respect to revenues in a year? Very difficult to understand, especially in light of the rally that we've already seen.
Know your customer. I think the customer base is really, really important here. This is a number that I wasn't aware of. Amazon, Meta, Microsoft, Google, the largest customers of Nvidia, 40% of its revenue. So if you're worried about where the revenue is coming from, we're talking about the most dominant firms on the planet that are absolutely minting cash. And this is where they're spending it. This company right here.
So if you're worried about it running out, don't be so worried, because they've got plenty of cash to spend. To your point, this is the issue, though. At what point is there pushback about how much the margins are, about how much they're charging for chips that they need for their cloud computing, generative AI offerings? So far, the sky's the limit. It seems like, even with China, it doesn't seem to matter when it comes to how much they can increase their revenues.
The stock is up by 13%. I've mentioned a few times we haven't talked about the Fed enough, so let's do that now.
Have you?
Kinda. Minutes from the Fed's January meeting showing members were united in delaying rate cuts. Only a couple of officials pointed to risk to the economy from waiting too long. Hotter than expected inflation prints since then are adding to concerns. JP Morgan's Marko Kolanovic seeing risks of stagflation. Writing this, investors should be open-minded that there is a scenario in which rates need to stay higher for longer and the Fed may need to tighten financial conditions. And then harking back to at least the 1970s for Marko and a team over at JP Morgan.
He's very much alone in that. I just want to put that out there. He's been alone on a lot of calls.
He's been quite lonely this year.
He's been lonely last year, too. But this is really a question going forward is how is the Fed going to respond to inflation that seems to be continuing? And how do we deal with what the ramifications of that is, considering what the ramifications are, considering that artificial intelligence has been such a game changer? Does it even matter for so many companies? For the economy, sure, but does the economy even matter if you're invested in the S&P 1?
Based on these Fed minutes overnight, yesterday afternoon, there's going to be some Democratic senators that are pretty lonely, aren't they? Remember those letters they were sending to Chairman Powell? I'm not sure they registered.
Elizabeth Warren, Senator Whitehouse, sending these letters saying you cannot keep rates this height and restrictive. They're talking about issues for individuals trying to get on the mortgage property ladder. And when you look at the Fed minutes, it's only a couple of participants pointed to the downside risks, what this means for the economy. So there's a big gap between what some of these senior Democrats are saying and what the Fed actually thinks where we are right now in the economy.
Huge. That's enough of the Fed. Let's turn to this stock. Moderna, rising after the pharmaceutical manufacturer reported fourth quarter revenue that beat estimates. The company saying it captured a greater share of the COVID vaccine market in the fall, while it also expects regulators to approve its second commercial product this year, a vaccine for RSV. CEO Stefan Bancel calling 2023 a, quote, year of transition as we adapted to the endemic market. Stefan, I'm pleased to say, catches up with us again. Stefan, you've been a wonderful friend of this programme over the last year or so. It's great to catch up with you again, sir. I just want to go to that market share story around COVID vaccines. How did you do that? Where did that come from?
So a lot of hard work and also being able to communicate to doctors that the two mRNA vaccines are not the same. And so if you look at the real world evidence, we have actually less hospitalization of people on the Moderna vaccine than the other vaccine. We've also been partnering with pharmacies to make sure we get the message out. So the team has done a lot of different activities to ensure that we get the share that we think we deserve. We had 30% share in 2022, and we're very pleased to have 48% share in the fall of 2023.
Stefan, do your investors still ask about COVID vaccines, or are they much more interested in, say, a melanoma vaccine or some sort of using this technology to prevent cancer?
I mean, both. If you think about Moderna, there is much more to Moderna than COVID. So on the one hand, they want to understand the COVID sales and how we're going to grow the COVID sales and layer on that RSV sales and then flu sales, because the respiratory franchise is going to be an anchor to Moderna forever, because those viruses are not leaving the planet. But of course, we are very excited about the future. I mean, we have a 9 product in late-stage pipeline, including cancer, but also, rare genetic disease. And so it's a very exciting time for Moderna because they're getting the existing products, but they're looking forward to the sales growth delivered by the pipeline.
So on one hand, when you talk about RSV or you talk about COVID, there's the question, we were talking about regulatory risk, the regulatory boon of, say, the CDC coming out and recommending that everybody get these shots every year or mandating it for certain positions. Are you expecting that to be the case with things like RSV?
I mean, think about RSV, it is mostly a risk for the elderly and the very young children. So I think the current guidelines of vaccinations for the elderly makes a lot of sense. And we were all very surprised actually about the number of people who got the RSV shot last year. It was much higher than any analyst had forecasted. So we're very excited because not only we have a great product in terms of efficacy, a very good safety profile, but if a product is approved by the regulators, which could come as early as May 12, that's the FDA PDUFA date, we could be the only product available to healthcare professionals in a pre-filled syringe. And that's really important. As you know, there's a lot of labor shortage in healthcare professionals, especially very acute in pharmacy retail chains. And if you think about the fall season, the pharmacists are very busy. They have to do their usual work, delivering a lot of products for people, and flu shots, and COVID shots, and now RSV shots. But the two products available on the market are pretty tedious. One of them is 9 steps of preparation. The other one is 4 steps of preparation. Well, Moderna, again, if approved, will be the only product that is pre-filled syringe. You take it out of the fridge, you clean the arm, you inject it, you put a Band-Aid, you are done. I really believe that healthcare professionals are going to be delighted with our product.
Stefan, that's what I wanted to ask you. You mentioned COVID, flu, RSV. So many vaccines individuals need to get in the winter. So if you had this one shot, it would save a lot of time. And frankly, it would be a lot easier, probably, and appetizing for people to actually go out and get it. But what is the timeline? When can we see that actually go to market?
So that's one of the other exciting news coming for 24 is we shared last year the phase 2 data of our COVID plus flu combo in a single dose. We should see this year the phase 3 data based on the platform that we have and what we've seen with COVID, with RSV and flu. I expect the phase 3 to be positive. If it is positive, we'll file it to regulator. So you could see this available in pharmacies as early as the fall of 25. So that's another exciting differentiation we will have versus traditional flu players and traditional COVID players.
Stefan, I know we're against the clock with you. You've got a busy morning. I just want to squeeze this in. The RSV shot, what are you learning about the durability of the protection it offers? Because as we understand, based on recent reports coming from you, maybe it doesn't last as long as the competitor and their offering does. And it makes me wonder, does that affect approval? Is that going to affect your competition? against that competitor as you roll that one out?
Yeah, actually, if you look at the data, we're very confident about our profile. And if you look at the data of the other vaccine, they also wane. And so if you look at what we're going to have in the marketplace, I think it's going to be very, very similar to what's available today. So I don't think that's going to be an issue at all.
Stefan, got to leave it there. We promised that you'd escape at about 7:38, so you can. Stefan Bancel, the Moderna CEO. Thanks, Stefan. Great to catch up. Thank you, sir. Hope Domchowski, CFO of First Horizon Bank, is still with us. Hope, I don't want to talk about the pandemic. I want to talk about what's happened since. Have you been surprised by how much has changed or by how much has remained the same?
Both. I'm very surprised by how much changed, and we thought the change was here for good, and now it's going back. If you talk about, let's start with remote work. Nobody was going to go back in the office. Everybody was efficient, and then you see a lot of CEOs saying back in the office 2 days a week, 3 days a week. We're back in the office 5 days a week for managers, 4 days a week for employees. We've seen a huge uptick in productivity, especially for our junior associates, that being in the office, that talking to people. And we're seeing our branches uptick again. We thought everybody had figured out how to use digital and nobody was going to go in a branch. Remember, there was talk, there's never going to be cash again. The U.S. system's going to go cashless. And so everything changed pretty materially, and I think we thought it was going to be for good, and we're seeing it swing back. Same thing as we were talking about CRE earlier.
Yep.
We saw huge vacancy rates 2 years ago, and the expectation was everyone's going to just shed office buildings. You were going to hear huge corporate real estate headquarters just being shut down all across, and we're not seeing that. Because even if you're in the office 2 or 3 days a week, you need a seat for those people.
You mentioned junior bankers. Are they coming back beyond the junior bankers, the whole staff? Are they coming back because they want to or because you're forcing them to?
I mean, I would like to say it's because they want to. They will all say, I'm sure, it's because we're forcing them to. But there's a mix in it, right? We do still have the same flexibility we had before, but it's important to be in the office working together, getting to know your colleagues, that collaboration. We lost a lot of that with virtual work, especially as we were onboarding new employees. When you try to build a culture, one of the things First Horizon's very proud of is we have long tenured employees, and that leads to long tenured clients. And to build that relationship, that mentoring with our junior associates, we really saw that fall away.
So let's talk about what has changed. We talk about consumer behaviors, the YOLO trends, the fact that everyone's been traveling, the fact that people spend in a different way. How is that manifesting in your business, in what your clients are doing, and how you're sort of seeing opportunities in areas that are less appealing?
I don't think there's any areas that are less appealing. We love our clients and we want to be there for whatever they want to do. On the consumer side, we haven't seen spending fall off the way that we thought it would. If you would have modeled 3 years ago, 500 basis points of rate increase, we would have thought we'd see a lot more unemployment, and we're just not seeing that. Consumers are very healthy in this economy. They still have discretionary money. In the commercial side, they're still employing. They're still creating jobs in our local markets. I love being in regional banking. One of the great things I get to do as a CFO is go meet with our clients and see the new projects they're putting up and go. I was in Middle Tennessee in December, and I visited 2 sites where we were creating 300 jobs in some of our smaller cities by the loans that we were giving. So we're continuing to see a really strong economy, especially in the Southeast.
This sets up the obvious question. Why America needs more than 4,000 financial institutions? Why we need 4,000 plus banks when we don't see that model in Canada, we don't see that model in my home country in the UK. Why do we need it here?
I don't know that we need more than 4,000, but I'm not sure that we also want to go to 5 either. Right? The U.S. Economy is so healthy, and our average loan size for First Horizon for our commercial banks is $2 to $3 million. And so the clients that we're serving are not the same clients that are going to be able to get the loan terms from JP Morgan or Citibank that have, I don't know what their average size is. You might know more than me, but I'm sure it's not 2 to 3 million on commercial loans. It's probably 3-4 times that. And so the regional banks are really the Main Street banks. Our bankers are in the markets. They live there. They know their clients. They're excited to fund a new project that brings 100 jobs to their community. And so there is an ecosystem in the U.S. as a booming economy that the banking system here provides for.
We're looking forward to talking interest rates in the Federal Reserve with you. We'll do that in just a moment. Think this one over. Are higher rates good or bad for bank stocks? Because Lisa and I have been talking about that now for the last 18 months. Still haven't got an answer, have we?
Some people say it's the shape of the curve. That if you get an uninverted curve, that's going to be the change. And so that's the reason why we're struggling with
Hope
this.
is going to answer that question next on this programme. Let's get you an update on stories elsewhere this morning. We can do that with Sonali Basak. Hey, Sonali.
Good morning, John. We're looking at the latest Quinnipiac University poll showing that a majority of voters think President Biden's age is a major issue heading into the election. 67% of respondents say the 81-year-old Biden isn't fit for a second term, and only 34% says he has the mental fitness to remain in office. Meanwhile, Donald Trump got slightly higher marks, with 41% of respondents saying he is too old to run. Trump is 77 years old and would be the oldest person to be inaugurated if he wins. Now, a woman billed as one of the most likely candidates to become the next CFO of Goldman Sachs is reportedly leaving the firm. Beth Hammack has been with the bank for 3 decades, and she moved into her latest role running the financing unit after being passed over for CFO in 2021. No woman has ever been appointed to the role of chair, CEO, president, or CFO in the company's history. Goldman and Hammack declined to comment. Now, Qantas and Air New Zealand have been impacted by aircraft delivery delays. Qantas said the delivery of its ultra-long-haul Airbus A350 would be pushed back, delaying the start of direct flights from Sydney to London and New York. While Air New Zealand now expects its new Boeing 787 Dreamliners to arrive next year, delaying the rollout of bunk beds in economy class that were due to be introduced on flights to New York and Chicago this year. That's your Bloomberg Brief, John.
Shanali, thank you. Appreciate it. Up next on this program, looking for clarity on the path to rate cuts.
We should not overreact to 1 month of data. Markets, in my opinion, really did, and I don't think the Fed did. They looked through a lot of the noise.
Live from New York City, that conversation up next. Live from New York City, good morning to you. Equities on the S&P 500 up by 1.2% on the S&P. Nvidia is absolutely flying. Tweet of the day comes from Zero Hedge. I'm going to talk with guests about this. I think this is great. $2 billion delta between Nvidia's revenue forecast and estimates translates in over $1 trillion in market cap gains this morning. All-time highs in the US, Japan and Europe. More on that comment a little bit later. Under surveillance this morning, looking for clarity on the path to rate cuts.
They want more data. The data need to be good, not better. There are a lot of January effects. There were a lot of anomalies in that data. We need to see more, and yet we should not overreact to 1 month of data. Markets, in my opinion, really did, and I don't think the Fed did. They looked through a lot of the noise.
Here's the latest this morning. Fed minutes from the January meeting showing officials warning against cutting interest rates too soon. Since that meeting, hotter than expected inflation data muddying the path to rate cuts. Kathy Jones at Charles Schwab sticking with her call, writing the Fed will likely initiate the first rate cut at the May or June meeting, assuming inflation continues to trend lower. Kathy, I'm pleased to say, is with us now. Kathy, let's get to that. Your takeaway from the Fed minutes yesterday, how stale were they?
They were a bit more hawkish than I expected because they contrasted with the tone of Fed Chair Powell's comments in the press conference. So I was a little bit surprised to see more reluctance on the part of the committee to initiate cuts. I don't think that changes the story one way or another. And I would agree with those comments from Claudia Sahm not to overreact to 1 month's figures. But it does seem to be more hesitancy than we thought there was at the Fed to start rate cuts. I guess they just need more data, as they keep saying, and they need more evidence that that inflation is going to stay down.
We now have to wait until July for the first rate cut to be fully priced into the market, although it's almost fully priced by June. And I'm wondering, Kathy, how you're thinking about what this new hawkishness, this one data point or 2 data points that doesn't necessarily make a trend but does make a market, how much that has affected your view going forward?
Well, we're still in the May or June camp. We've been sort of on the more moderate side of things all along, expecting the Fed to take its time. So I haven't changed that call yet. If we were to get a blockbuster employment number again, where, you know, we see huge jump in jobs or huge jump in wage growth, then we might push it back even further. But I think at this stage of the game, just like the Fed, we're waiting for more data to try to assess what they're thinking in terms of the first rate cut and the path after that.
Kathy, how much weight do you put on current market pricing? Do you think we should consider current market pricing just as a weighted average of multiple views? That's a view that's come up on this program a few times. We spoke to Mike Schumacher of Wells Fargo yesterday, who said that once the weakness kicks in, we're going to price in 200 basis points of cuts like that really fast. How much weight would you put on what's currently priced?
Yeah, it's going to vary. Like we've seen so much volatility in expectations over the last year or so that I would agree that it's going to shift very quickly if we get real economic weakness, which we haven't seen. I mean, let's face it, the economy keeps chugging along at a pretty good pace. Even though inflation's coming down, the economy's pretty resilient. So I think that if he's right that we're going to see weaker economic data, sure, we'll price in faster rate cuts.
Kathy,
so there's room for the.
Just to jump in, forgive me, do you have a view on how big that cutting cycle would be?
So our expectation is that in this year, they'll cut 3 to 4 times, so 75 to 100 basis points. I'm not sure we're going to get to that terminal rate of 2.5% that the Fed has been talking about, because it does look like we have a more resilient economy. And if we get a productivity boom that at least seems to be slightly on the horizon, or we can be hopeful that we're getting an improvement in productivity, that raises our underlying growth rate and raises the underlying neutral rate. It's not inflationary, but it certainly can raise the neutral rate because our growth rate is stronger. So that might mean that the end rate is more like 3% rather than 2.5%.
Kathy, just before you go, one final question. Top call right now. We've had a 40 basis point repricing since the end of last month at the front end of the curve. What do you like and where do you like it across the curve?
We still like investment-grade corporate bonds. That yield curve in the corporate bond space is positively sloped by just a little bit. So if you want to extend duration without taking a lot of credit risk, we still think that that's a good place to be.
Kathy, you're one of the best. It's great to hear from you. Kathy Jones there, Charles Schwab. Kathy, thank you. Hope Domchowski, CFO of First Horizon Bank, still with us around the table for some final thoughts. Hope, let's finish with this one then. I promised I'd ask this, so I've got to ask this. Are higher rates good or bad for bank stocks? Because over the last 18 months, we've had some difficulties.
The answer is yes, both. That's the problem, is there's not one answer for banks. First Horizon's an asset-sensitive bank. 70% of our balance sheet has repriced. And so we have one of the best margins and net interest income in the industry right now. So higher for longer is better for us. We're seeing credit really is still stabilized. It's, deteriorating, but really stabilizing to the pre-COVID level. However, there's a lot of banks that are liability sensitive, that are sitting on, underwater bonds and securities, and they need rates to go down. And I think that's the current issue. What's good for banks is certainty. As soon as we figure out whether it's going to be higher for longer, whether we're going to get down to a terminal, rate of 350, is it going to end up at 400, then I think it's good for the banking system. Uncertainty on either side, rising or decreasing rates, is really hurting bank stocks.
How frustrating is it to you that smaller banks have to pay out 5.5% to their CDs holders and to their depositors, whereas the JP Morgans of the world can pay out maybe, 3% to their CDs because they are JP Morgan?
It's frustrating as a CFO, but as we look at the funding mix. But as I think about these are clients. We don't use our CDs. We don't use our money markets as a way to fund the bank. They're really long, deep client relationships. We announced after the TD deal was terminated, we went out and got 32,000 new clients for $6 billion of deposits in 45 days. And 98% of those, or 96% of those have stayed with us. And so when you're paying a client 5.5% as a CFO, you get a little bit more comfortable with it, but it is frustrating. The frustrating thing was how much of the non-interest bearing deposits left the regional bank during the banking crisis and went up to, the too big to fail banks and haven't quite come back down. That's the harder part for me.
That's where I wanted to go.
Free money, right? It's just free.
So that's where I wanted to go. How difficult has it been to retain those non-interest-bearing deposits? Have you been able to attract them back due to the relationships, or has that ship kind of sailed?
I don't think it's sailed. It's getting harder. We've had to push more into marketing than we've had to push in probably a decade on the retail side of acquiring new clients. We've had to do a lot more with our branches. As I mentioned earlier, more and more people are coming into branches. It's amazing. We have a brilliant chief marketing officer who's done a great job. And the first time she's like, I need this much money to send out mailers. I was like, who looks at mailers? And yet we saw the campaign results and people still walk into a branch with a mailer and say, I want a 5.25% CD. And so we're having to get back to kind of old banking tactics that in zero rate environments, people weren't shopping their deposit accounts.
It's amazing. Can we just finish on deposit insurance just quickly and regulation? What kind of reforms are you advocating for at First Horizon?
The biggest one for us at First Horizon is the tailoring in Basel III. Treating a $100 billion bank like a $1 trillion bank for long-term debt, capital hold, it is it is a really hard pill for us to swallow. For us, we estimate that Basel III, if implemented with the TLAC and the long-term debt, would be about a $75 million expense add to our $2 billion expense base. How do you tell shareholders that tripping over $100 billion is that much more valuable to them when we have to add that much more long-term debt onto our balance sheet?
We've heard that a lot. Lisa just wants to know whether you're sending out toasters to get people to open up accounts.
Mugs. You know, that comes up a lot. We've been asked whether people should have toasters. Bobbleheads were a big one during,
Of who? Are you going to have a bobblehead of you?
Well, I grew up in New Jersey, so I still have a Derek Jeter bobblehead. Back when the Yankees used to give out bobbleheads. Do you remember that opening day?
Yes.
That's amazing.
Oh, Mets fan? Well, they probably didn't give out bobbleheads.
I'll just take the cash. I'm happy to deposit wherever.
Exactly.
I'll just take the cash. Remember the cash bonuses?
Okay,
They're still around.
My first account, and I was like 11 or something, a child account. I got a little folder and I got little pens, and it was very exciting for me, but I was 11.
I'm still with that bank in the UK. Same one.
Seriously?
First one, same one.
Can I open a new account for you, John?
We can do that.
We might be
I'll
able to
give
get you a
call.
bobblehead if you want one. I can call my
I'll
chief
take
market
a
officer. I need
bobblehead.
one bobblehead.
I'll take that. I'm not sure we can negotiate this stuff live on air, but I'll take a cash deposit, a toaster, a bobblehead, and whatever else is going. Ove, it's good to see you.
Thanks, John, for having me.
Thank you so much. Thank you. In the next hour of Bloomberg Surveillance, Mona Mahajan of Edward Jones, Henrietta Trays of Vader Partners, Michael Dada of Roth MKM, and Gene Soroka, Executive Director of the Port of Los Angeles. The third hour of Bloomberg Surveillance is coming up next, with equity futures on the S&P higher by 1.3%. Nvidia still flying.
We're not really sure when the Fed goes the first time. Is it June? Is it July? For most of your viewers, it simply doesn't matter.
The Fed is steady as she goes in many ways, and it's creating, I think, a lot of volatility.
I think inflation is stickier than maybe some folks would have thought.
The lumpiness in inflation is just part and parcel of going through what we're going through, a normalization of interest rates.
A lot of the inflation data that we saw recently was largely seasonal, and that will reverse in the next couple of months.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance with a focus on one name, Nvidia. It is the best performing stock on the S&P 500 over the last 12 months, year to date, and this morning too. The stock is higher by almost 13%. The numbers are amazing. The price reaction is incredible. So let's start with the numbers, and then we can talk about the price action elsewhere. The numbers: revenue more than triples to $22.1 billion US dollars. Go back to 2021, they didn't even generate that much revenue in an entire year. The profit's incredible, reporting a 486% year-over-year growth in earnings per share. Okay, you've registered that. So let's talk about the reaction to the outlook. This from Zero Hedge. I think we need to chew over this because they're on the money. A $2 billion delta between Nvidia's revenue forecast and estimates translates in over $1 trillion in market cap gains this morning. We've got all-time highs in Europe. We're back to the highs of 1989 over in Japan. And the US maybe is going to make a high of its own a little bit later.
We asked the question, how do you extrapolate out exponential growth at a company that does seem to be at the vanguard of a sea change in society? And the question is, this is how you do it, really imprecisely with a dartboard, basically throwing at it and just saying it's going to keep going up. And that's essentially what Zero Hedge was pointing out. But this is the issue. When do you stop? When do you go neutral, to Luke Cowher's point, which isn't a bearish neutral, it's just a how much further can we go neutral?
AMH, we talked about the career risk of not being long this name based on these gains we've seen, not just over the last few months, over the last 12 months plus.
Well, yeah, overnight there was one lonely seller last night who now is a hold this morning. So no one is saying on Wall Street, if you look at the analyst recommendations, that you should sell the stock. Hold it or buy it, overweight on this. I like what the Saxo head of equity said, because it's what I said when I looked at the numbers. Quote, insane. You almost can't absorb how well they're doing. And I still go back to, and I feel like I'm a little bit about you, Lisa, lately. I feel like I'm a little gloomy. But I look at China. This is the biggest market for semiconductors. And what they're looking at is revenue is at 22% at one point. It's now 8.8%. And they have to stay there because they cannot, with these export controls, they cannot get the best chips they have into China. And China doesn't want to downgrade some of these companies. So they just have to maintain this. And even with China being the largest semiconductor space, they're still putting out these numbers. So I keep thinking, what would these numbers look like if they were able to tap into Chinese growth?
You don't even need to sit that close. It just sort of rubs off on you. It's only been a month So just wait 12.
And no one even knows. When I walked in this morning, we were wearing the same color. So.
with black turtlenecks.
Just sort of the bearishness sort of kicks in. You start dressing the same. I'm with you. I feel it. It's rubbed off on me as well over the last few years.
The black turtlenecks.
So bearish. I'll be wearing teal and turtlenecks and the whole thing. Do you want to talk about politics? Let's play this game. Guess whose quote this belongs to? OK, this is on the Capital One Discover potential merger get-together. This is destructive corporate consolidation at its starkest. If consummated, this merger will create a juggernaut in the credit card market with unprecedented powers to extort American consumers. That cannot be allowed to happen. That is not the senator from Massachusetts. That is the senator from Missouri. Senator Hawley has got something in common with Senator Warren.
Well, politics, sometimes you have strange bedfellows. And we have seen Senator Hawley and Senator Warren also have a lot to say about the banking sector last year when you saw those regional banks fail, saying these executives, you should claw back some of their pay. But the tone now is firm in Washington about some of what's going on in M&A. We've reported the FTC is not going to go through, or they're going to sue, for the merger of Kroger and Albertsons. We know what's happened with JetBlue. And now you have Capital One and Discover. And we just had a regional bank CFO join us, who said our deal from TD was going to be the last big mega merger in banking sector. Do they actually think this deal can go through when senior Republicans and a senior Democrat are saying absolutely not?
Hope Domzhowski of First Horizon with us just moments ago, and I think she got to the heart of the issue, big time. And the frustration that you have, Lisa, with the political debate of the moment. Here's the problem. There is a view, based on the last administration, that the former president, if he becomes the next president, will be easier somehow for business, that these deals will just come together, executed, and we'll move on. Based on what we heard from Senator Hawley yesterday, and according to Axios, that letter that they produced, I wonder which way the wind is going to be blowing in the Republican Party, given this populist stance that's quickly emerging on this front.
And if where the wind blows is where people's views are going to be. How do you create policy if you're an executive with an actual balance sheet and actual money you got to put to work? This is the frustration with Washington, D.C., and the reason why I'm trying to remain engaged and disciplined throughout this process.
You want to talk Washington, you want to talk policy.
100%.
And that's the issue. We're not talking policy.
I mean, whether it's the deficit, whether it's actually which mergers are accurate, whether it's how to protect a regional banking system that did experience stress and did experience a flight of non-interest bearing deposits, there are some real issues. This question of entitlements, this question of our international footprint after years of having a reputation that really were hinged on that. All of these things are valid conversations that we should be having.
They don't always win elections.
They don't win elections.
Who wants to get up on the podium and talk about the deficit and cutting your entitlements? No one.
That's why I've got a bit of an issue with politicians, in case anyone wasn't aware. Anyway, equities right now on the S&P 500 firmer by 1.2% on the S&P. In the bond market, yield to look like this, a little bit higher by 2 basis points, 433.65. Coming up this hour on the programme, Mona Mahajan of Edward Jones on why she doesn't see bubble behaviour for AI stocks. Henrietta Trays of Vader Partners on bipartisan efforts to stop the Capital One Discover deal. And Port of LA Executive Director Gene Soroka on global trade disruption. That one is a must-watch a little bit later this hour. We begin with our top story. Global stocks moving higher on the back of NVIDIA's blockbuster earnings. Mona Mahajan of Edward Jones seeing more room to run, writing this. We don't see bubble behaviour in this AI cohort because the earnings and growth opportunities seem quite real. In this backdrop of pending Fed rate cuts, inflation potentially moderating, and the economy showing scope for re-acceleration in the back half of the year, we believe remaining fully invested is a sound strategy for the year ahead. Mona is with us right now. Mona, I want to go to that quote we've been referencing from Zero Hedge. I understand the numbers are tremendous, but let's talk about the price action and the response to them. They're pointing out quite clearly, and we can see it in the numbers, there was only a $2 billion, I say only, but given the stock we're talking about, that matters, only a $2 billion difference between the revenue forecasts and the estimates, and it's unleashed the monster of all rallies. Mona, what explains that?
Yeah, thanks, John. And look, I think there's a couple things that we can take away from the NVIDIA call last night. One, there were still questions on whether this generative AI trade was real. Are there real revenues being generated, or is there real demand? And I think NVIDIA continues to answer that question for us in an extremely positive yes, there is. And in fact, I think CEO Jensen said last night, generative AI is at a tipping point. We are at the start of a very solid investment cycle in this trend. So number one, generative AI, while people have had thought perhaps it's a 5-10 year cycle, which we still think we're at the early phases of a 5 to 10 year bull market, we are starting today. And number two, and we talked about this briefly, is the valuations that have come out of these magnificent seven names broadly, and NVIDIA in particular, you would expect after a 200% plus rally over the last year, NVIDIA's valuations may have skyrocketed. In fact, we've seen valuations come in a bit. So for those that have been comparing this cohort to the 1999-2000 tech bubble, in fact, we're not seeing all that much similar behavior, especially from a valuation perspective. So we do think there are positives that have come out of these earnings calls. What we will say broadly is, yes, we're starting with the Magnificent Seven, the enablers of AI, the building blocks of AI, but over time we see the gains and the positivity spreading to those that will be benefiting from the productivity. So areas like industrials, healthcare, et cetera, that should benefit down the road.
An old friend of mine in London, Ken Vexler, just wrote to me this quote I want to share with you all. Do I want to be right or do I want to make money? A tale as old as time itself, intellectual gratification versus actually doing the job you're there to do. Mona, it's easy, I think, to throw mud at some of the rallies that we're seeing, particularly in a Magnificent Seven, particularly in the Magnificent One. Mona, how difficult is it just not to be invested in big tech, given the gains we're seeing over the last 12, 18 months?
Yeah, I think when we think about how these indexes have kind of evolved over time, we know the S&P 500, 45 to 50% now is in three sectors, and that's tech, comm services, and consumer discretionary, and all the Magnificent Seven is housed there. So if you are an investor, even invested in index ETF, you have about 50% exposure to large cap technology. And so it almost has become intertwined with investing in the US market. From our perspective, it does make a lot of sense to be involved early on in some of these gains where we see this long-term secular trend emerging. Over time, we would expect, as we noted, a broadening of leadership. We do think, if we are in a cycle where we're not only in a generative AI cycle, we're in a Fed potentially rate cutting cycle. And by the way, there's an election cycle coming up in the background as well. But we do think in that backdrop where the Fed may be cutting, where you're probably going to get over time at least better inflation trends, and that those both will help the consumer and the economy, we may see early cycle behavior reemerge, and that includes a broadening to areas like cyclical parts of the market, areas like small caps and mid caps, and perhaps even international play some catch up as well. So we want to make sure that we are diversified, but we don't want to give up that 45% exposure to the S&P 500 large cap technology space.
Are U.S. government bonds diversifiers still?
Yeah, we still think in this environment where yields are still relatively high, we don't see the Fed coming back to the zero bound. We think they'll stay somewhere in their neutral range of 2.5% to 3% longer term. That still is a pretty good environment for investment grade bonds. And if you think about, the environment post-crisis where we were at the zero bound, it was a primarily growth story. We think the next 5 to 10 years look like growth and value, but importantly, bonds do play a more meaningful part of your portfolio. And if you think about duration broadly, of course, at this point, you're not only locking in, if you do extend your duration to some extent, especially away from those CDs and money market funds, or at least complement them, you're locking in some of these better rates for a longer period of time. You have the potential still, we believe, for price appreciation as the Fed begins its rate cutting cycle. And so very much, yes, we think bonds are actually going to become a mainstay in portfolios more than we've seen really in any time in recent history.
I asked this of Ben Goodrich earlier today. Are you bearish on anything?
What we'd say is we want to be cautious about, last year was the trade of Magnificent Seven, mega cap tech, and probably CDs and money market funds. So we want to be cautious about remaining too overweight in those cash-like instruments. And we've seen a little bit of that complacency and that behavior from investors who have benefited from 5% plus yields. Keep in mind, there is some reinvestment risk on the horizon as the Fed starts cutting rates. There is an opportunity cost to those, CDs and money markets, especially as we've seen, S&P has been up 24% in 2023. We're up, 5 to 6% this year already, well exceeding, money market rates. And so that's the only area that I'd say just be mindful of, the complacency that comes with just reinvesting into money markets and CDs.
Mona, thank you. Appreciate the answer. It's the same as the answer to the last person who answered that question. Mona, thank you. Mona Mahamajan of Edward Jones. It's like spitting in a bear's face. What are you bearish about? Cash. That's what I'm bearish about.
I mean, literally, that's a great way of putting it. It's basically everything that you like, we don't like because you're too cautious. This is just sort of giving you a sense of how full bull everyone's gone.
Equities right now, full bull, up by 1.2, 1.3% higher on the S&P. Let's get you an update on stories elsewhere this morning. morning. Here's your Bloomberg brief with Shonali Basak. Hey, Shonali.
Hey, John. The head of Boeing's 737 MAX unit has been ousted from the company. Boeing says Ed Clark is stepping down effective immediately after nearly 18 years of service. The management change is the first since the door panel blowout on an Alaska Airlines flight earlier this year. And Boeing CEO Dave Calhoun is expected to meet with FAA officials in Washington next week as part of the ongoing investigation. Now, minutes from the Fed's January meeting showed that most officials remain more worried about the risk of cutting interest rates too soon than keeping them too high for too long. Policymakers want to see more evidence that inflation is firmly on a path to their 2% target before they lower interest rates, with some concerns that progress could stall. Officials agreed that interest rates were likely at their peak, but the exact timing of the first rate cut remained unclear. And we're also watching President Biden because he is on a campaign fundraising swing through the West Coast, and he's sharpening his rhetoric against Russia and the Republicans. At an event in San Francisco, he called Vladimir Putin a, quote, crazy SOB, and laid into GOP frontrunner Donald Trump for comparing his legal battles to the death of Republican opposition leader Alexei Navalny. Biden's three-day California tour has included fundraisers that will add $130 million to his campaign coffers. And that's your Bloomberg brief, John.
Shonali, thank you. Angry Biden is part of the strategy. That's the campaign strategy now. Angry Biden.
Yes, he has been angry. He has come out with a little bit of a temper, which he's known to have, and he's kind of sounding off. And he does this more so when he gets into a room with donors at a campaign event.
Yeah, but do you think this is really about the campaign who believes that this shows and demonstrates he's more engaged? That he's not a fragile, disconnected old man?
Potentially.
That he's more engaged, he's angry about these issues?
Well,
is that what this is about?
Because we're sitting around the table at 8 a.m. talking about it. So potentially that is working.
Anger sells, period, full stop. Whether it's populist anger about credit card bills or whether it's the anger that people feel when they log on to social media, and that's what sort of is the algorithm.
What's also interesting, he was talking about climate. This is the full quote. This is the last existential threat. It is climate. We have a crazy SOB like that guy Putin and others, and we always have to worry about nuclear conflict, but the existential threat to humanity is climate. So it was within a pitch about climate that he mentioned that this Putin SOB.
OK. More Angry Biden coming up later this year. Up next on this programme, Senator Hawley and Senator Warren agreeing on something.
The kind of pro-competitive impact of strengthening Discover as a competitor to Visa and MasterCard is going to be more compelling when it actually goes to litigation, if it does.
That's next on the programme, live from New York City. This is Bloomberg. Stocks on the S&P 500 higher by a little more than 1%, about 1 hour and 12 minutes away from the opening bell. Under surveillance this morning, Senator Hawley and Senator Warren agreeing on something.
I do think there is a general allergy to any kind of concentration. So the pressure to scrutinize it, I think, is very intense. Certainly to draw out the review. I see no reason to think this is going to go through quickly. How it goes in courts is a different question, I think. The kind of pro-competitive impact of strengthening Discover as a competitor to Visa and MasterCard is going to be more compelling when it actually goes to litigation, if it does.
Here's the latest this morning. Republican Senator Josh Hawley joining Democratic Senator Elizabeth Warren in speaking out against Capital One's proposed $35 billion mega deal to buy Discover. Hawley writing this, sounds like the credit card companies are finding another way to screw the American people. This merger should be blocked, and Congress ought to cap credit card rates pronto. Joining us to discuss antitrust is Henrietta Trays of Vader Partners. You get the good stuff this morning. Shutdowns, antitrust, these two agreeing with each other. What is that about? Where do you think the wind is blowing in the Republican Party? Is Hawley alone or has he got company?
I think Hawley's in good company, and he's bringing more people to the party. As Lisa said before, anger sells, and it brings, all the girls to the yard. The most important person to watch, though, is always going to be Sherrod Brown in this situation, and his commentary is much more sanguine. He's in a very difficult re-election race right now. He's not going to allow anything to happen that upsets and ruffles feathers. So if you want to skip over the anger and exciting TV, that's where you would go and follow.
But he still put out a letter almost immediately saying they need to to look at this.
Yep.
What could Congress do? Because obviously this lies with the FTC and the DOJ.
I mean, I'm afraid to answer that question because Congress obviously can't do very much, right? They can barely keep the lights on. So I don't anticipate much beyond maybe a hearing. I can't anticipate them getting too in the weeds for the regulators who will very much be doing this of their own volition. Members are going to talk about it, but I don't think they'll do much.
Speaking of keeping the lights on, they're struggling to do that. Potentially next week, we could see a government shutdown. The Freedom Caucus is saying this: we're not going to secure significant policy changes if we're not going to do that, or even keep spending below the caps adopted by the bipartisan majorities less than 1 year ago. Why would we proceed when we could instead pass a year-long funding resolution that would save Americans $100 billion in year one? They're talking about this McCarthy-Biden deal. What's your expectation? Because they have basically 2 days to get this done.
Yeah, exactly. They have 2 days, and it's only $300 billion worth of the overall government spend. The big tranche is not till the following Friday when we get $1.2 trillion that would fall off. Effectively, what I think here is we'll get another short-term CR because those $100 billion in cuts go into effect May 1st. And we're just waiting and kicking the can till then. So the reason I'm up here and talking to clients is basically to say we're going to have one more punt. And then in mid-March to mid-April, we'll get a big deal that'll tackle the sequester. It'll tackle, Ukraine-Israel border, maybe something to do with the tax bill potentially, although I have low odds there, and a $55 billion domestic aid package.
But the Freedom Caucus letter to Speaker Johnson basically proves this very difficult position he's in. He either deals with the Democrats and keeps the government open, but deals with the Democrats and loses his job. Is that a potential for him?
I think the losing your job potential is real. However, that October period when they went 3 weeks without a speaker is something that's still very fresh on the Hill. If you go and talk to members, they remember how awful that was. And be mindful that they went through many members on their roster. It's not like there's folks waiting in the wings to step in as the next speaker. So I don't think Johnson's at immediate peril. I think he can get one more shot on goal with another short-term CR. And then the real fight will happen in April.
So when you talk to clients who are in the market, what do they do with this?
I mean, there's an understanding that on Friday, it's only $300 billion. I've been with clients all week, and they're basically like, oh, this one doesn't matter. No one cares about these. It is military construction VA, amongst others, energy and water, transportation, HUD. It's not irrelevant or anything, but you can see from the temperature and urgency on the Hill, no one really much cares. It's the following Friday, March 8th. And the interesting thing about that week is that Super Tuesday's on Friday, the 5th, the State of the Union's on the 7th, and the real government shutdown's on March 8th. So it's going to be a lot.
Just to go full circle, it used to be that the Republican Party was considered the party of business. Is it still?
No, definitely not. You can talk to the U.S. Chamber of Commerce about that. They do not have that business lobby that is able to just railroad through the Republican Party, whatever they say goes. Now it's a tremendous amount of pushback. I hear things from Senate Finance Committee and tax staff basically saying, we didn't get any points for lowering the corporate tax rate. And then the business community came back and suspended fundraising after January 6th. There's a lot of hurt feelings, and that animosity grew and exploded during the Trump administration, and it has not cooled off. In fact, I think it's gotten quite a bit worse.
I think this is really interesting then, because there is this lingering perception, lingering from the last administration, that Trump is business friendly, and we'll get more of that if he gets back into power. Are you saying maybe we won't?
I think Tom Donahue in the U.S. Chamber of Commerce would tell you that he is not business friendly, and Republicans will go to the mat to combat ESG aggressiveness, any kind of corporate wokeism. We didn't get a tax extenders bill last year when we very easily could have, and I don't think we're going to get one this year because the R&D tax credit, the EBITDA to EBIT shift, the bonus depreciation provision, those are giveaways to corporations that are not necessarily exclusively siding with Republicans anymore. They donate to Democrats, and Republicans remember that thing.
What kind of policies are you expecting then out of a Trump administration if it is indeed the next one?
We're going to extend the 2017 tax cuts. Just keeping things neutral will cost $2.7 trillion. And one of the things I find really interesting is that the street considers that a fiscal easing. But it's incredible because if you look at history, since tax cuts started, you can go back to Reagan, they don't go up. They just keep going down, and we get extenders packages. The same thing happened in 2010 when we extended the 0103 tax cuts, again in 2012, both under Democratic presidents. And that's what the Democratic agenda in President Biden's budget is very likely to show when it comes out. Most, if not all, of the tax cuts for individuals at least under 500K are going to be extended.
Given the cost associated with that, are you saying that once they've done that, there's not much space to do anything else?
They don't raise taxes. They cut taxes. They do not raise them. They let some expire, but that's as close as they get.
Henrietta, it's great to see you. Good to see you here in New York. Henrietta Trey's there at Vader Partners. Bramo, I think that got to some of the issues you focused on.
Yeah, the fact that essentially there's not going to be any financial discipline in Washington. So this raises this question about auctions. You know, there was a 20-year auction yesterday. It didn't go that well. It's not because of the deficit, but anyway.
20-year maturity is an odd one.
I know, but it still causes off. Whatever. But moving on, there really raises a question. They're not going to deal with taxes only go down. They don't go up, right? And guess what? Entitlements don't go down either. So what has to give, and when does this become a real conversation?
Peter Cheer of Academy Securities is talking about exactly the same thing. Brendan Murray, our colleague out of London, wants us to ask, a Chinese-made port crane spying on us, which seems to be an issue at the moment. Port of LA director coming up a little bit later. Cybersecurity effort coming from the president as well. That's actually a focus in some ways, you know.
Well, very much so.
Well, front page of the New York Times this morning has a lot to do with this in terms of Chinese spying on a bunch of companies as well as U.S. allies around the world.
That's the back half of the show. Look out for that. Coming up next on the programme, before we get there, breaking jobless claims. We'll get you the reaction with Michael McKee and Michael Dowder of Roth MKM from New York City. With equity futures on the S&P 500 positive here by 1.3%. Live from New York, this is Bloomberg. Equity futures on the S&P 500 shaping up as follows. We're positive here by 1.3%, about 1 hour away from the opening bell. In the bond market, yields are higher by a single basis point. Your 10-year 433.45 in foreign exchange. The euro 108.39, positive here by 0.2%. Waiting for jobless claims. The estimate is 216. The previous number is 212. Jobless claims exceptionally low. If you take the chart, stretch it back decades. We haven't seen numbers like this one. And Mike, it gets better.
It gets better. And this is interesting news because this is the week that represents the February payrolls survey. 201,000 initial jobless claims last week. That's down from 200 and what it was last week. It's a decrease of 12,000 from the previous week, so we only went up by 1,000. So 213 last week, 201 this week. Continuing claims up to 1,862,000. Actually, that's a decline from a revised 1,889,000. The continuing claims are a week behind the initial claims, so because the initial claims fell last week, we're catching up with the continuing claims. But basically, the bottom line of all these numbers is nothing wrong with the labor market at the moment.
Amazing. Let's just run through the boards, Mike, very quickly. In the equity market, still near session highs, up by like 2% on the NASDAQ 100, on the S&P 500, up by 1.25. The equity market, because of NVIDIA and AI, could not care less about what's going on in the bond market, seemingly. But we should talk about what's going on in the bond market. We've got a 4 basis point move higher at the front end of the curve. The 2 years just gone through 470. So if you go back to when the Fed last met, at the close that day, the 2 year closed at something like 420. So we've repriced yields higher by 50 basis points off the back of decent payrolls data, hot CPI, hot PPI. The ISMs were pretty decent as well. And now jobless claims, Lisa, dropping back to 201,000.
What I find interesting is not so much the front end response, it's what we're seeing in the 10-year yield. It's now at the highest going back to November of last year, and it's rising actually faster. And this, to me, is raising a question about whether people are now considering what happens when you get strong growth despite 5.5% Fed funds rates. Does this mean that the actual inflation rate is going to be higher and that the growth rate is much greater than many people think?
The stock market is ignoring this. The bond market is not. FX market isn't either. The dollar is stronger. The euro is almost unchanged on the session now at 108.27. Mike McKee, let's talk about this. This data over the last month or so seems to be shaking up market-based expectations of the Fed, but doesn't seem to be shaking up the Federal Reserve just yet. How much weight are you putting on it?
Well, we put weight on it because obviously the data are suggesting something is happening in the economy. The question is, these are all one-off so far. One CPI report and basically one jobs report that revised a previous one. We have to see if that's continuing. But you go to the minutes yesterday, and usually the minutes don't mean a whole lot. But in this case, the markets have taken it as having some meaning because the Fed was pushing back against the idea of early cuts, which was the market thinking at the time. But now the market is taking this as, well, maybe they knew something that we didn't know about how strong the economy was. So right now we're seeing a repricing toward where the Fed has been. So it's not going beyond that yet. And it does tighten up financial conditions, which helps do the Fed's job for it. You mentioned the potential growth rate maybe being higher. That's going to be the next debate, is when the Fed starts cutting, how low do they go? There's already been comment from Fed officials about the possibility that the neutral rate is higher. We'll see if they can calculate. I mean, when you look at the calculations, there are about 20 different models. It seems to be a little bit higher, but does it stay there?
You said financial conditions are tightening. Sure, you get a couple basis point move and the bond yield higher, but we just heard from person after person the biggest risk out there is having cash, because you really just need to be invested in absolutely everything because it's going to be an amazing year. At what point does that become problematic for a Federal Reserve that did give a nod to that in the meeting minutes by saying that this could stall some of the progress on disinflation?
Katie Greifeld and I yesterday were reminiscing about Alan Greenspan and his irrational exuberance comments, and the fact that then the market a couple of years after that blew up. Does that happen again? We don't know. When you say invest in everything, it's basically invest in 7 things, it seems like. So the Fed looks at that and says, what about the rest of the market? Is the rest of the market being overpriced, which we saw in the late 1990s. And the Fed officials I've talked to have said they don't think so at the moment. They're keeping an eye on NVIDIA and all these others because obviously bubbles can pop if it is indeed a bubble, but it isn't broad.
Mike McKee, thank you, sir. Equity still near session highs at 1.3%. Let's run through it. Bond yields are higher off the back of hotter than expected jobless claims. The right kind of downside surprise, as we like to say. Yields are up by 3 or 4 basis points through 470 on a 2-year. Lisa looking out further along the curve, up 2 or 3 basis points to 434. Dollar just a little stronger off the back of this against the euro, 108.32. You can see this on the chart as jobless claims drop. Dollar strengthens, euro just a touch weaker. On the session still, the euro against the dollar is positive by about 0.1%. Mike Dada of Roth MKM joins us now to get it into these numbers. Mike, let's talk about them right now. Jobless claims coming at 201. We're looking for 216. Previous week, 213. How much weight, Mike, are you putting on this data? Payrolls, hot. CPI, PPI, hot. ISM, decent. Claims, lower. How much weight are you putting on that?
Yeah, thanks for having me on, John. If we just focus on those, I mean, the discussion would probably rapidly shift to when is the Fed going to raise rates again, which you at least have a small minority of folks talking about. But we had some other data that was actually quite soft. Retail sales for January missed. Fairly weak internals. Industrial production and manufacturing were also soft. So in the broad context, I think the data is more mixed, but no doubt about it, those Fed minutes I do think were revealing in the sense that we do see the Fed continuing to push back on both the timing and the magnitude of the easing that was expected coming into the year. And one of the things that we've been writing about is, the consensus view seemed to shift to this idea that we'd have no recession or an economic acceleration, double-digit profits growth, and 6 rate cuts anyway. And that didn't seem to make a lot of sense. Our view was you get the rate cuts if the economy really weakens. And if it doesn't, then the Fed's going to be, pushing back on those expectations. And that's what we have here with the 10-year yield now up into the 430s, the last I saw.
Mike, you said timing and magnitude. Talk to me about timing, and then we'll get to magnitude. What kind of timing are you thinking about now?
Well, it's interesting. I mean, the Fed funds futures markets, the implied yields over a 3-year horizon, I think are up about 70 basis points from the lows last year. So that's a fairly big move. That explains why the 10-year yield is rising. We're not really seeing a breakout in bond market inflation expectations here, but it looks like, the cuts now have been pushed, not just from starting in March to May, but, perhaps not until this summer. And it'll really depend on the data. What Fed Chair Powell is saying is that we don't know where the neutral interest rate is. Tom likes to say the Vixillian equilibrium rate. It'll depend on how the economy performs. If the labor market is holding up, if so-called financial conditions are accommodative, then the Fed is not going to have a compelling reason to start cutting rates in any meaningful sense. And so I think it really is data dependency to an extreme for the Fed here now.
So, Mike, let's talk about the data. We can have 12 months of economic data. Look at 2023. Growth was strong. Unemployment was low. It was south of 4%. Mike, we were at 5.5% through much of the back half of that year. What did we learn from that?
Well, what I learned was that I think we had a fairly big positive supply side shock last year. That was really the surprise. If we look at real growth, it accelerated last year. Nominal growth actually decelerated. And that is the textbook supply and demand definition of a positive supply shock. Yet some of the early reads on inflation coming into this year don't look so hot. You mentioned the CPI, the PPI was also hot. So we're probably looking at a fairly warm PCE deflator for January as well. So if that positive supply side shock is mostly behind us, then I do think we're going to see the economy decelerate through the course of the year. But expectations are pretty high here given the surprise last year, which is that real growth accelerated. But for the Fed, they really control nominal variables. So if the policy stance is restrictive, then one would expect nominal growth to slow. That's been happening and continue to slow. The question is, can the Fed really thread the needle here on the neutral rate in a way that preserves the business cycle? And, that has been yet to be seen, even though you had a lot of people jumping up and down and taking victory laps on the soft landing last year. Sure, soft landing so far, but the final chapters haven't been written just yet.
There's a lot to unpack there. I want to just sit, though, on the idea that continuing claims fell last week and that this is going to be one of the key contributors to the February jobs report, given the fact that we're looking at a decline in initial jobless claims on the week. Mike, at what point does this data speak to a resilience that you are not expecting that makes you change some of your expectations for the year?
Yeah, I certainly think that, the claims data has surprised to the upside, no doubt about it. We did see a spike in both initial and continuing claims last year that now seems to have unwound. In fact, we were getting a fairly strong recession signal out of the continuing claims data, up year over year, 20+%. And now those numbers have started to pull back. So we'll see whether that's sustainable. One thing that makes me a little bit nervous about just completely embracing the claims data in an unadulterated way is that the NFIB small business data that we got for January, the hiring plans index made a new cycle low in January. That's a very powerful, although a bit volatile, 6-month forward indicator for the unemployment rate. Sometimes claims actually tend to lag the cycle a little bit. Going into the 07-09 downturn, jobless claims really didn't make a recessionary move until the spring of 08. And so they're important. Let's watch the claims data. Let's give them credit for hanging in there. The picture looks good if we just isolate the claims numbers, but there's a broader story to tell here.
Is that broader story that you still see recessionary signals later in the year?
Yeah, I'm still worried that we haven't soft landed yet. I think the Fed is going to really be pushing back on the timing and magnitude of the rate cuts, and that does create the risk that if and as things slow, we think they will, the Fed will fall behind the neutral rate curve, and that's how business cycles tend to end. We've had 18 months of an inverted yield curve. So, historically, that's fairly rare. When we have seen that, we've either been at a cycle peak or about 6 months from recession. So the lags do look longer here than the average historically, but we're just not quite out of the woods yet. And the consensus view seems to be, pretty coalesced around this idea that we've successfully soft landed. We really are out of the woods. We've dodged the recession bullet. And that's really not our view.
Hey, Mike, it's another hot data point. Mike Dada of Roth MKM. Appreciate it, Mike. Soft landing so far. Mike's words, the final chapter hasn't been written yet. The data looks pretty tremendous again. Jobless claims dropping to 201, the estimate 216. Need to get you an update on the network outages here stateside. Here with your latest is Bloomberg's Sonali Basak. Hey, Sonali.
John, the latest is that AT&T, the largest wireless carrier in the United States, is confirming network issues and service disruptions. According to Down Detector, thousands of customers reported issues starting around 3:30 a.m. Eastern. And AT&T spokesman Jim Greer saying in a statement, quote, "We are working urgently to restore service, and we encourage the use of Wi-Fi calling until service is restored. The cause of the issues or the number of people affected remains to be seen. Verizon and T-Mobile both say networks are working normally." Now, the latest Quinnipiac University poll shows a majority of voters think President Biden's age is a major issue heading into the election. 67% of respondents say the 81-year-old Biden isn't fit for a second term, and only 34% say he has the mental fitness to remain in office. Meanwhile, Donald Trump getting slightly higher marks, with 41% of respondents saying he is also too old to run. Trump is 77 years old and would be the oldest person to be inaugurated if he wins. Google is pausing image generation of people on its AI service Gemini. The platform is coming under criticism for how it handles race. Users on social media pointed out historical figures, including popes and founding fathers, were being portrayed in a variety of ethnicities and genders. Google responded, saying Gemini's AI image generation does generate a wide range of people, and that's generally a good thing, but it's missing the mark here. That's your Bloomberg Brief, John.
Shanali, thank you. I'm not going to comment on that story. I'll avoid that. Can I just say, turning around and telling people to use the Wi-Fi is the most ridiculous thing I've ever heard. I mean, seriously, what did they think we were going to do?
Yeah, exactly. Just not use the phone.
Oh, yeah, sure. Yeah. I hadn't thought of that. Thank you.
How many hours has it been before they actually acknowledged it?
It's literally been more than 5 hours.
Exactly.
No offense to any engineers that are listening to this, but it's like when they tell your computer's not working. Well, did you turn it off and turn it on?
This is what it feels like.
Yeah.
Turn on the Wi-Fi. Hadn't thought of that. Thank you, AT&T. Appreciate it. Up next on this program, global trade disrupted.
We have rejigged our network completely, sailing everything south of the Cape of Good Hope, and expect to do that for a while until we have really safe passage reopened in the Red Sea. So this could be with us for a while.
That conversation up next. Live from New York City this morning. Good morning. Equities positive here by 1.3% on the S&P. Under surveillance this morning. Global trade disrupted.
We have rejigged our network completely, sailing everything south of the Cape of Good Hope, and expect to do that for a while until we have really safe passage reopened in the Red Sea. So this could be with us for a while. But we're also working constantly with all stakeholders to try to shorten this crisis as much as possible and get back to normal trading route.
Here's the latest. Red Sea tensions and a drought in the Panama Canal disrupting global trade as President Biden steps up U.S. port security. The White House implementing cybersecurity requirements for port owners, with officials saying over 200 ship-to-shore Chinese cranes can be serviced and programmed remotely. Port of LA Executive Director Gene Soroka saying his team is ready to work with the Biden administration on this effort after establishing cybersecurity operations back in 2014. Gene, I'm pleased to say, joins us around the table here in New York. Gene, it's always great to catch up. Good to see you.
Good morning, John.
Let's get to the big question of the day. Are Chinese cranes spying on us?
They're collecting data. They're looking at information. 53% of the Port of Los Angeles businesses trade with China. What they're using that data for is the question.
Yeah, that's basically a yes then. This is what Ann Neuberger, the U.S. Deputy National Security Advisor for Cyber, had to say about it in the Wall Street Journal report. We felt there was a real strategic risk here, these cranes, because they are essentially moving the large-scale containers in and out of port. If they were encrypted in a criminal attack or rented or operated by an adversary, that could have real impact on our economy's movement of goods and our military's movement of goods through those ports. The U.S. ports use 80% of these cranes owned by China. This is a massive risk.
It is a risk, but Annmarie, who else makes the cranes? And that was the emphasis in part of this discussion that the NSC, DHS, as well as the Coast Guard had with the media the other night, and further onward discussion is taking place today. How can we create that industry here in the United States to build these big shoreside cranes that are 175 to 200 feet tall, managing these large ships that come into our nation's ports?
Have you been made aware of any wrongdoing, though, that has actually gone on, or is this just at this moment a concern?
This is a great watch out for all of us in the port industry. At the Port of Los Angeles, we implemented the nation's first cybersecurity operations center with the help of DHS back in 2014. Last year, that cybersecurity operations center, or CSOC as we call it, stopped nearly 750 million cyber intrusion attempts at the Port of LA. We then created the Cyber Resilience Center, bringing in nearly 24 Private sector entities partnered with IBM, and that's stopping now intrusion attempts at the private sector level that folks weren't aware of.
This is a crazy busy time for your port. So we've got ships rerouted around the Red Sea, away from the Red Sea. We've got low water levels in the Panama Canal. What kind of capacity are you running at? What percentage of capacity are you at right now?
Right now, John, we're between 75 and 80% capacity. January was a big month, up about 18% from last year. Combination of a number of things. Long-term labor deal in place with our dock workers, confidence returning to the marketplace, and a 4 percentage point jump in market share. I was over in India and Southeast Asia last month, and what customers were telling me was subtly they're starting to move a little bit more of their cargo away from traditional routes, going through either the Suez or Panama, and targeting that towards the west coast of the United States, specifically Los Angeles.
This is what I want to get to. How much of this increased business is down to just an increase in underlying activity because business, economic growth is doing okay, and how much of it is just rerouted from other places?
It's a combination of all three. Again, stability in the market, rerouting of cargo, and we've had 6 consecutive months of cargo growth at the Port of Los Angeles. There continues to be stocking and distribution through fulfillment centers of goods that the American consumer is buying.
How much is the activity being rerouted, not only from the Suez Canal and the Panama Canal and some of these other hotspots, but also from the East Coast because of concerns about a labor shortage or a labor strike that's going to disrupt some of the activity there?
All of it, Lisa, kind of anecdotal right now and off one-on-one conversations we've had. What I don't see yet are traditional vessels in those other routes being pointed at the direction of Los Angeles. So it would be akin to going to the airport and instead of flying over London to get to Mumbai, you're going over Singapore and coming the other way. That's basically what it looks like. More folks are booking on our traditional services coming to LA across the Pacific, and those other services, as our friend Vincent Clerk said, are rerouting around the Cape of Good Hope, adding more vessels into the existing strings to make up for that weekly transit need.
To tie these ideas together, the idea of Chinese cranes and the idea that they're not being made in the U.S. and trade picking back up even if people have to reroute boats, is the whole concept of nearshoring a fiction? And is what you're seeing right now essentially that we have the same economy that we used to, where things are manufactured outside of the U.S. and brought in, maybe through different ports of entry, but ultimately from the same places?
Yeah, what we're seeing, Lisa, in these conversations with companies are that it's front of mind every day. And in our industry, whether it was building containers, the chassis or trailer wheels that haul the cargo, or the cargo handling equipment and shoreside cranes, many folks from Washington to the manufacturing community are asking, how can we take over that manufacturing process, at least on a percentage basis, and bring it a little bit closer to home?
Gene, you talked about the labour contract on the West Coast. I remember talking to Marty Walsh every month about it when he was in the administration. That's in your past. It might be in the East Coast future. What are the lessons from your experience, and what are you expecting to take place in the year to come on the East Coast?
Well, interestingly enough, I was texting with Acting Labor Secretary Julie Su last night. She's going to be in Los Angeles for an LA Chamber of Commerce meeting this Saturday, where we'll visit. The East Coast folks have their contract coming up this summertime for expiry, but please remember, they haven't gone on strike since the mid-1970s. Now, there are big issues. These workers have to be paid. The companies must be resilient to bring more cargo in. And there are specificity around automation or robotics that have to be addressed. It's a big issue, and you'll see some folks get a little bit nervous and shift their cargo away, just like we witnessed.
Did you see the forces that led to that? Did you see that as just a moment in time or a new regime? How did you view that labor contract?
Well, I think it was part and parcel of an entire labor movement across the country. Back home in LA, whether it was the school district, the actors and writers, the UAW in Detroit and the upper Midwest, and now what we're seeing in our transportation industry, the UPS contract with Teamsters, right? Folks worked through the pandemic with no regard for health and safety. They were out there trying to keep this American economy moving. Record profits in our industry. Got to pay these folks what they're worth.
What was notable about the contract in LA, the ports there, is that it was a 6-year contract. Most notably, these are 4-year deals, right? Do you expect that going forward, that we can potentially make these contracts longer?
Annmarie, it all depends. Traditionally, in our PMA ILWU contract on the West Coast, they had been 6 years in duration. But of more recent times, we saw protracted negotiations getting us a little bit off calendar, and then some extensions in the last presidential administration in Washington, because there was some trepidation about how that group would react to the labor movement. So it's kind of all over the board, but getting back on a more normal calendar would be great for the industry, the workforce and companies.
Busiest January, second busiest January on record. Am I right?
That's right.
Amazing. Just amazing numbers. Gene, it's good to catch up.
Great
Always
seeing
is.
you all.
Thank you,
Thank
sir.
you.
Gene Soroka, Port of Alice LA Executive Director. And I think he said that they're kind of spying on us, but not really spying on us because we don't know what they're doing.
He
with it.
danced around it, but it sounded like a yes to me, just in a lot of words.
Just a slight yes. My
Data
words.
collection,
not
spying.
his words, kind of.
Everyone's spying on us. I mean, this is sort of, who isn't spying on us?
AT&T isn't.
AT&T
Not this morning.
Not this morning. They're not. But it's sort of, you can call it spying or you can call it data collection. You can call it whatever you want. The question is, what do you do with it? And what are they going to do with it at a time where trade's really at the forefront of a lot of tensions?
Gene, it's good to see you. Always is. Thank you, sir. Coming up tomorrow morning, we'll be catching up with Mohammed Al-Erin of Bloomberg Opinion, Queen's College, Cambridge, Peter Cheer of Academy Securities, RBC's Amy Wood-Silverman, and Jay Pilosky of TPW Advisory. All of that and a whole lot more. Let's touch base on the price action going into the opening bell. 34 minutes away. Equity futures on the S&P 500 positive by 1.35% on the S&P. Nvidia check if we can. Just briefly, there we are. Off session highs, up a mere 12%. Just 12%, Bramo.
Yeah, well,
Nvidia this
it's
morning.
going to be what, just $200 billion of market cap?
Just amazing, isn't it? Going to see a big market cap move in about 34 minutes' time. Live from New York City. We'll catch up with you tomorrow. Thanks for being with us. This was Bloomberg Surveillance.